You open your phone, launch Robinhood, Binance, or Fidelity, and stare at those flashing green and red candlesticks. One minute your account is up a few $100s, the next it's bleeding red and everything's gone. Your heart races, your palms sweat, and you wonder, is this really investing or just high-tech gambling? That's the vicious cycle millions of Americans are stuck in. We get obsessed with buy low, sell high every second, chasing the waves of Bitcoin, meme stocks, or the latest hot picks on Reddit, only to end up sleepless, stressed out, and sometimes completely wiped out. Benjamin Graham, Warren Buffett's mentor, left us with a timeless truth. Smart investing isn't about guessing whether the next candlestick will be green or red. It's about having a method, discipline, and a long-term mindset. The intelligent investor doesn't teach you how to get rich overnight. Instead, it teaches you how to avoid stupid mistakes, protect your hard-earned money, and steadily build real wealth. And if you've ever asked yourself, how can I invest without living in constant fear every day, this video is your answer. Hit like and subscribe so you won't miss any financial lessons that could change your life. Part 1. The two types of investors: defensive and active. Benjamin Graham begins The Intelligent Investor with a very clear distinction. Every investor falls into one of two groups: defensive or enterprising, active. This isn't a label, but rather the path you choose depending on your time, personality, and financial goals. The defensive investor values safety, low risk, and doesn't want to spend hours analyzing financial statements. These are people busy with full-time jobs, family, and everyday life. For them, investing isn't about proving intelligence, but about protecting and steadily growing their wealth. The approach here is broad diversification, focusing on index funds like the S&P 500 ETF, along with a portion of government bonds or high-quality bond funds. For example, imagine an office worker in Texas who consistently puts $500 a month into a 401k invested in index funds. He doesn't care if the market is red or green today, but 20 years later, his portfolio could be worth over $1 million. That's the power of the defensive path: simple, patient, and effective. In contrast, the active investor seeks to beat the market. They spend time researching businesses, analyzing financial reports, and comparing intrinsic value with market price. But Graham warns, being active isn't about day trading, chasing trends, or jumping on meme stocks. True active investing means uncovering opportunities others overlook, buying stocks when they're deeply undervalued, and always respecting the principle of the margin of safety, which means only buying when the price is significantly below intrinsic value to reduce risk. For instance, instead of chasing Tesla at peak prices, an active investor might quietly buy shares of a small medical equipment company with steady profits that the market has ignored. That's the essence of active investing, according to Graham. The core difference between the two approaches lies in time, effort, and discipline. The defensive investor optimizes for simplicity, safety, and minimal time commitment. The active investor demands significant effort, deep analytical skills, and iron patience, but in return may achieve superior returns. In the end, Graham emphasizes, there is no single path that's right for everyone. What matters is being honest with yourself. Do you want to spend hours researching companies, or would you rather stick to a safe, low-stress strategy? Choosing correctly from the start will determine whether you become a truly intelligent investor or just another person led by the emotions of Mr. Market. Part 2. Mr. Market, the moody friend. Benjamin Graham created one of the most timeless metaphors in investing. Imagine you have a business partner who shows up at your door every single day, eager to either buy your shares or sell you his, always at some price he sets. The problem? His mood swings are extreme. On some days, he's wildly optimistic, convinced every company is destined to be the next unicorn, and he quotes high-sky prices. But the very next day, gloom takes over, and he's suddenly pessimistic, offering to sell everything at bargain basement prices. Graham's message is crystal clear. The market is not a compass for true value. It simply reflects the emotions of the crowd, sometimes accurate, but more often distorted by greed and fear. A smart investor doesn't chase after Mr. Market. Instead, they learn to take advantage of his mood swings, buying when prices are cheap and exercising restraint when prices are inflated. Warren Buffett, Graham's most famous student, captured this spirit in his legendary advice: be fearful when others are greedy, and be greedy when others are fearful. In other words, when Mr. Market is panicking and selling at dirt-cheap prices, that's your golden opportunity. But when the crowd is euphoric, convinced prices can only go up, that's when you need to be the most cautious. Think back to 2020, when the COVID-19 pandemic hit. Apps like Robinhood, Fidelity, and Charles Schwab were flooded with plunging candlesticks as millions of investors panic-sold airline stocks like Delta and American Airlines. Yet those who had the discipline not to follow Mr. Market's mood and even bought more while others were afraid, saw those stocks rebound strongly in the years that followed. In the end, Graham teaches us this: treat the market as your servant, not your teacher. It offers opportunities, but it's up to you to decide whether you'll stay rational or be swept away by the crowd's emotions.
Part 3. Margin of safety. If Graham had to choose just one principle to define an intelligent investor, he wouldn't hesitate. It would be the margin of safety. This principle means you only invest when a stock's price is significantly below the company's true intrinsic value. In other words, you buy with a safety cushion to protect yourself from unforeseen risks. Graham compares it to building a bridge designed to hold 30 tons, but only allowing vehicles weighing a maximum of 10 tons to cross. That difference is the margin of safety, ensuring that even if something unexpected happens, the bridge won't collapse. Investing works the same way. You can't predict every risk, economic crises, technological disruption, or fierce competition, but you can protect yourself by never overpaying for an investment. For example, if a company's intrinsic value is $100 per share, Graham would advise buying only when the market price drops to around $70 or lower. That $30 gap acts as your cushion, helping shield you from mistakes in valuation or sudden market swings. This principle remains just as relevant today. Look at the tech bubble of 2000. Millions of investors bought .com stocks at prices inflated dozens of times above their real value. When the bubble burst, most lost everything because they had no margin of safety. On the other hand, patient investors who stuck to companies with real value and waited for prices to drop deeply became long-term winners. Warren Buffett, who turned this philosophy into his investing mantra, once said, "Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And the only real way to avoid losing money is by always maintaining a margin of safety in every decision." In the end, Graham reminds us that success in investing doesn't come from the smartest moves, but from avoiding the dumbest mistakes. And the margin of safety is the shield that protects you from those pitfalls. Part 4. Value investing versus speculation. Benjamin Graham argued that the biggest mistake many market participants make is failing to distinguish between investing and speculating. These two concepts may sound similar, but they are fundamentally different in mindset and approach. According to Graham, value investing means carefully analyzing a business, looking at financial statements, profitability, growth potential, and intrinsic value. Then, you only buy when the market price is below its true value, and you're willing to hold the investment long-term, regardless of short-term fluctuations. In other words, investing is a process of making decisions based on reason and data. By contrast, speculation often stems from the expectation that a price will rise in the near future, regardless of the company's fundamentals. Speculators tend to chase rumors, short-term charts, or crowd sentiment. Speculation relies less on value analysis and more on emotion and luck. A clear example is the GameStop frenzy in 2021. Millions of retail investors rushed to buy GameStop shares not because the company had sustainable profits, but because they believed prices would continue rising thanks to Reddit and media hype. That's pure speculation. Some lucky investors made quick profits, but many others bought at the peak and suffered heavy losses when the price collapsed. Meanwhile, value investors often take a contrarian approach. They may buy overlooked companies with solid financial foundations, durable competitive advantages, and market prices below intrinsic value. They're not looking for gains in weeks, but are willing to wait years for the investment to reflect its true worth. Graham emphasized that value investing doesn't promise quick wealth, but it protects you from the destruction that speculation can bring. Warren Buffett summed this up perfectly. Stocks aren't a game where people with IQ 160 beat people with IQ 130. What you need is the temperament to control your emotions and not become your own worst enemy.
Part 5. Portfolio and Balance. Benjamin Graham believed that one of the most important principles of becoming an intelligent investor is maintaining balance in your portfolio. In other words, you shouldn't put all your money into stocks, nor should you keep everything in bonds or cash. Instead, allocate your assets wisely so you have both growth potential and protection when the market gets volatile. He suggested a basic formula: 50% stocks, 50% bonds. Depending on your risk tolerance, this ratio can shift. For example, 75% stocks and 25% bonds for someone willing to take on more risk, or 25% stocks and 75% bonds for a more defensive investor. The key point is that you should always have a portion of your assets in something safe, so you're not completely wiped out if the stock market crashes. Take the 2008 financial crisis as an example. Many U.S. investors had all their assets in stocks and lost 40 to 50% of their value in just a few months. But those who kept a balanced portfolio with some government bonds or high-quality corporate bonds significantly reduced their losses and were able to stay afloat, ready to seize opportunities when the market recovered. Graham's reminder is clear: no one can predict what the market will do tomorrow. So maintaining balance in your portfolio is like wearing armor. It protects you from unexpected shocks. That's how an intelligent investor survives and thrives over the long term. Part 6. Discipline and Psychology, the investor's greatest enemy. Benjamin Graham emphasized that an investor's greatest enemy isn't the market, it's their own emotions. Greed when prices rise, fear when they fall. This cycle leads many people to buy at the top and sell at the bottom. He stressed that to become an intelligent investor, you must learn to control your psychology. Investing requires discipline, sticking to your strategy rather than letting short-term emotions take the lead. A disciplined investor patiently waits for opportunities, buys when prices are below intrinsic value, and is willing to stay on the sidelines when the market gets overheated. We see this in action every time the market swings dramatically. When stocks plunge, most investors panic and sell, fearing even greater losses. But those who keep a cool head realizes that it's precisely during market panic that the best bargain opportunities arise. Graham's lesson is clear. Smart investing isn't about trying to predict the market. It's about mastering yourself. If you can maintain discipline and control greed and fear, you've already overcome the toughest challenge on the path to becoming a successful investor. Part 7. The final lesson. Smart investing is patience. As the intelligent investor comes to a close, Benjamin Graham leaves us with a simple but profound message. Smart investing isn't about getting rich quickly, it's the art of patience. He believed that the market will always have its moments of madness, booms followed by busts. But the greatest rewards go to those who can wait, who place their trust in intrinsic value rather than chasing short-term swings. Patience not only helps you avoid rash decisions, but also allows you to witness the power of time,
when compounding and gradual accumulation build lasting wealth. This message is just as relevant today. In a world where everything seems to demand fast, from news to profits, it's the slow and steady approach that sets you apart. The intelligent investor doesn't need to predict the future perfectly. They need to stick to their strategy, wait for opportunities, and trust the process. So, if you want to become a true intelligent investor, remember this: patience is your greatest strength. Thank you for watching until the end. I hope these lessons from Benjamin Graham help you stay grounded on your investing journey. Wishing you clarity, patience, and good fortune in every financial decision.
Do you believe that just by sitting still and doing almost nothing, you could end up wealthier than 90% of investors out there? That's right. Most people lose money not because the market is too difficult, but because they trade too often, pay too many fees, and let their emotions take over. John Bogle, the father of index funds, proved that if you want to build lasting wealth, all you need is simple, disciplined, and patient investing. In today's video, I'll share with you the 6 most valuable lessons from the Little Book of Common Sense Investing, a book that completely changed the way Americans invest and build long-term wealth. If you want to learn how to make money work for you instead of constantly chasing the market, hit like and follow this channel right now so you won't miss future summaries of investment books that can transform your mindset and your financial future. Part 1. The core of the investment philosophy. John Bogle begins with a tough truth. Most of us will never beat the market over the long run. Not because we're not smart enough, but because we lose on 2 invisible battlefields: costs and emotions. The more you trade, the more fees you pay. The more you let fear and greed drive your decisions, the more your real returns get eaten away. So what's the smarter path? Bogle says, don't try to beat the market, own the market. A total market index fund, or even just the S&P 500, is basically buying a basket of large companies, allowing you to grow alongside the entire US economy instead of betting on just a few names. When you own the index, you share in the profits, dividends, and long-term growth of America over 10, 20, or 30 years, without having to predict what happens tomorrow. Bogle calls this common sense investing. The simpler, the better. You don't need to time your entry into Apple or Costco. You just buy the whole haystack instead of hunting for the needle. Broad diversification reduces the risk of putting all your eggs in one basket, while the ultra-low costs of index funds ensure more of the returns stay in your pocket. This difference might look tiny in a single year, but over 30 years, it becomes massive. Imagine 2 investors. Alex chooses an actively managed fund with a 1% annual fee. Jordan picks an index fund with a 0.05% fee. If the market's long-term return is around 7% before fees, then after 30 years, Alex's initial $10,000 might grow to about $57,000, while Jordan's grows to nearly $75,000, a gap of more than $17,000 starting from the same place. And if both invested $500 a month for 30 years, that tiny fee difference could snowball into more than $100,000. That's compound interest working for you or against you depending only on fees. Real life shows this clearly. A teacher in Ohio steadily contributed to her 401k index fund starting at 25. No predictions, no buy the dip, sell the rally, just automatic deposits every paycheck. By retirement, her account far outpaced her neighbor, who spent years chasing stock tips, trading in and out, racking up fees, short-term taxes, and panic selling every time the market dipped. A nurse in Texas opened an IRA with a total market index fund, rebalanced once a year, and ignored the daily headlines. After a decade, her boring discipline led to steady growth, less drama, more net worth. Meanwhile, another friend got swept up in meme stocks, buying options during the frenzy and panic selling when things turned red. After a few years, what he had left was mostly tuition paid to the market. Bogle would say, that's not the market's fault, it's costs and emotions eating away your gains. Bogle's core message is simple but powerful. Own the market, keep costs low, and let time do the heavy lifting. You don't need genius to succeed. You need a system that's simple, transparent, and boring enough to stick with. Because it's exactly that boring consistency that gives you a shot at capturing America's long-term growth. When you stop chasing big wins and start steadily building wealth through index funds, you stop being a gambler on the news cycle and start becoming a co-owner of American business. And that's how common sense turns into financial freedom over time. Part 2. The power of compounding and low costs. John Bogle emphasized that two forces shape your financial future: compound interest and investment costs. One is your most loyal friend, steadily growing your money over time. The other is an invisible thief, quietly stealing away your returns. Imagine you invest $10,000 and leave it for 40 years. At an average annual return of 8%, it grows to about $220,000. But if you only earn 7% because of a 1% management fee, your money ends up at just $150,000. That's a loss of more than $70,000, enough to buy a small house or pay for a child's college tuition. If your net return drops to 6%, you finish with only $100,000, losing over $100,000 compared to the original scenario. All of that simply because of fees. Now, picture contributing $500 a month for 30 years. At 8%, you'd end up with nearly $750,000. But if your real return is only 6%, the total falls to about $500,000. That's more than $200,000 gone, just because of higher costs and not letting compounding fully do its job. And this isn't just numbers on paper. Think of Ronald Read, a humble janitor in the US. He never won the lottery, never ran a big business. He simply bought stocks, held them, kept his costs low, and let compounding take care of the rest. When he passed away, his wealth had grown to more than $8 million, which he left to his community and family. Contrast that with countless others who chased short-term trades, pay high fees, switch funds constantly, and after 20-30 years end up with only modest savings because their returns got eaten away by costs and poor timing. Bogle believed the secret to lasting wealth isn't about being smarter than the market. It's about being more patient and more frugal than others. You don't need to find the golden stock. You just need to avoid losing money to fees and give time and compounding the chance to work for you. The takeaway is, if you want to build real wealth, remember 3 things. Start early, invest consistently, and choose low-cost tools. Compounding will work its magic as long as you give it enough time. Part 3. The reality of active funds. Many people believe that if they just pick a brilliant fund manager, that person will beat the market and deliver superior returns. But John Bogle showed that in reality, the opposite is usually true. Active funds charge high management fees, often 1% to 2% per year, plus hidden trading costs as managers constantly buy and sell stocks. That might sound small, but over time, those fees eat up a huge portion of your returns. As we saw earlier, even losing just 1% a year can cost you hundreds of thousands of dollars over several decades. But the bigger issue is this: most active funds simply don't outperform the market in the long run. Data from S&P Dow Jones indices shows that more than 80% of U.S. active funds underperform the S&P 500 after 15 years. In other words, by just buying a low-cost S&P 500 index fund, you already outperform 8 out of 10 professional managers. One famous example is Warren Buffett's $1 million bet. In 2007, Buffett wagered that a low-cost S&P 500 index fund would outperform 5 hedge funds managed by top Wall Street experts over 10 years. The result? By 2017, the index fund returned about 125%, while the hedge funds averaged only 36%, a massive gap. Buffett won the bet and donated the money to charity. But more importantly, he proved Bogle's point that most managers can't beat the market, and you don't need to pay high fees to follow them. Think of it like running a marathon. An index fund is like running steadily, keeping your pace and focusing on finishing strong. An active fund is like constantly darting off the track, searching for shortcuts, only to end up more exhausted and still finishing behind. The market is tough to beat, and every attempt costs you in fees, taxes, and mistakes. Bogle's message is clear. Don't bet on someone else's ability to predict the market. Bet on the market itself. Buy a low-cost index fund, hold it for the long term, and you'll already be ahead of most of Wall Street's so-called experts. Part 4. Index funds, the simple path. In the world of investing, many people are drawn to complicated strategies, dense charts, and secret formulas that promise huge returns. But John Bogle believed that simplicity is the greatest strength. An index fund works in a very straightforward way. It simply buys all the stocks in a market index, for example, the S&P 500, which includes the 500 largest companies in the US, and then just holds them. There's no constant buying and selling, no guessing which companies will win or lose. As the US economy grows, the value of those companies rises, and you, as the investor, benefit. It's so simple that many people didn't believe it at first. Yet the truth is, index funds have helped millions of ordinary Americans become successful investors without needing deep financial knowledge. For example, a teacher in California shared that he consistently invested in an S&P 500 index fund throughout his 30-year career. He didn't need to study charts or track the news every day. By the time he retired, thanks to the power of compounding and the steady growth of the market, he had over $1 million in his account, far above the average result of most individual investors. The simplicity of index funds also protects you from emotional mistakes. People often fall into herd mentality, excited when the market goes up, panicked when it goes down. Individual investors tend to buy at the top out of fear of missing out, and sell at the bottom out of fear of losing more. But with index funds, you don't have to chase the market. You just keep investing steadily and hold on. As Warren Buffett once said, an investor doesn't need to do anything other than consistently invest in a low-cost index fund. Over the long run, that will outperform most Wall Street professionals. In other words, you don't need to be a genius to succeed at investing. You just need to choose the simple path, stay patient, and let the market do the heavy lifting.
Part 5. Discipline and long-term investing. John Bogle emphasized that investing is not a sprint, it's a lifelong journey. Success doesn't come from quick wins, perfect buying the dip, or lightning-fast trades. It comes from discipline, patience, and persistence over time. Imagine this. You invest $500 a month in an S&P 500 index fund, earning an average of 8% per year. After 10 years, you'd have about $90,000. After 20 years, that grows to more than $275,000. And if you stay disciplined for 30 years, the total surpasses $750,000. All from patience and consistent investing, not risky bets or complex financial strategies. The key is this: the market will always be volatile. At times, it will drop 20%, even 50%. But those who panic and sell during downturns are usually the ones who lose the most. Meanwhile, disciplined investors who hold steady and even keep buying when prices are low end up as the true winners. A clear example is the 2008 financial crisis. Many investors panicked and sold everything as the market collapsed. But those who patiently held their index funds watched their portfolios recover strongly within a few years and then soar to new highs in the following decade. Even Warren Buffett, one of the greatest investors of all time, once said, "My favorite holding period is forever." In other words, instead of chasing the market, let time and the power of compounding do the heavy lifting for you. Long-term investing requires discipline because it goes against human nature. We all want quick results, but sustainable wealth only comes from persistence over years, even decades. The message is crystal clear. Don't let emotions control you. Let discipline and time work in your favor. Part 6. Bogle's Life Philosophy and Legacy. John Bogle was not only a great investor, he also left behind a simple yet profound life philosophy. Put investors' interests first, live humbly, and pursue integrity in everything you do. When he founded the first index fund in 1976, Bogle didn't get caught up in promises of quick wealth or Wall Street's complicated schemes. He chose a different path, a path of simplicity, transparency, and low costs. This philosophy gave millions of ordinary investors access to the financial markets and a real chance to build lasting wealth. People often called Bogle Saint Jack, not because he was the richest, but because he gave back the most to the community. It's estimated that thanks to his low-cost index fund philosophy, investors worldwide have saved hundreds of billions of dollars in fees. That is a legacy not only in finance, but also in the way people think about fairness and transparency. Bogle once said, "Success is measured not by the money you make, but the difference you make in the lives of others." This sentiment runs throughout his book and is what elevates his thinking beyond investing, turning it into a life philosophy. Bogle's final message to us is clear. Invest simply. Avoid unnecessary complexity. Stay disciplined and patient over the long term. Above all, live with integrity and responsibility, leaving value for those who come after you. By following these principles, you not only build wealth for yourself, but also live a meaningful life, just as Bogle did throughout his remarkable journey. Remember, lasting wealth isn't about complexity or luck. It's about simplicity, discipline, and patience.
Have you ever wondered why some people earn millions of dollars yet still struggle to get by, while others with average incomes manage to live comfortably and stress-free? Money might seem like nothing more than numbers, simple addition and subtraction, but in reality, it's shaped far more by our emotions, luck, habits, and even the deep-seated fears within us. Morgan Housel, the author of The Psychology of Money, points out a powerful truth. No one is truly crazy when it comes to money. We all act based on our own unique experiences. And that explains why Americans spend over $1.3 trillion every year on things they don't really need just to impress people they don't even know. In this journey, we'll explore timeless yet powerful principles about money, from luck and risk to the magic of compounding, and most importantly, the freedom that money can bring. This isn't just a book about financial management, it's a book about how to think, so you can live wealthier, wiser, and with greater peace of mind. Don't forget to hit like and follow the channel so you won't miss out on more great books about money, finance, and personal growth. Part 1. Money and Emotions: Why No One is Truly Crazy. When it comes to money, we often assume that every decision should be based on logic, calculations, and clear numbers, but reality looks very different. If you take a closer look at people's financial behavior, you'll see it doesn't resemble math at all. It looks much more like psychology. Let me tell you a story. There was an American man born in 1940. His childhood unfolded in the years right after World War II, when the U.S. economy was booming. Between 1945 and 1970, the stock market kept climbing steadily, and real estate seemed to have only one direction: up. To him, investing was simply obvious, like a money printing machine. All you had to do was put in capital and patiently wait. He grew up believing that risk was temporary, but profits would always come to those who stayed the course. Now let's look at another person born in 1975. This person came to age right as the U.S. stock market collapsed in the early 2000s when the dot-com bubble burst. And before they could recover, 2008 arrived. The year of the financial crisis. Lehman Brothers went bankrupt, 8 million people lost their jobs, 6 million families lost their homes, and the average American household saw nearly 40% of its wealth vanish. For this generation, investing wasn't an opportunity, it was a wound. To them, holding cash felt safe, while stocks and real estate were nothing more than dangerous gambles. This reveals an important truth. No one is truly crazy in how they view money. Each of us acts according to our personal experiences, the memories etched into our childhoods and our lives. Gallup statistics confirm this. Before the 2008 financial crisis, about 65% of Americans owned stocks. After the crash, that number dropped to just 52%, and even more than a decade later, it still hasn't returned to previous levels. In other words, an entire generation reshaped its approach to investing simply because they saw with their own eyes their parents lose everything. That's why two friends, living in the same city, working the same job, earning similar incomes, can use their money in completely different ways. One may dive headfirst into the stock market, convinced that risk is simply the price of reward. The other might stash most of their assets in savings accounts, convinced that safety is what matters most. And both of them are right in their own way. Housel offers an interesting perspective. We often judge others as foolish or ignorant when we look at how they handle money. But if you stepped into their shoes, with their personal history, the events they lived through, you'd see that their actions actually make perfect sense. The problem is, we can never live through someone else's experiences. So instead of mocking or judging, it's better to accept this. Money is tied to emotions, to memories, to unique life experiences that cannot be repeated. And once you understand this, you'll stop looking for a universal formula that works for everyone. There is no one-size-fits-all solution. There's only the approach that fits you, your past, your beliefs, and your story. Part 2. Luck, Risk, and the idea of never enough. When it comes to financial success, we often hear the glorious stories. Warren Buffett with his legendary vision, Elon Musk boldly taking risks with Tesla and SpaceX, or Jeff Bezos building Amazon out of a tiny garage. Hearing stories like these, many people believe success is purely about talent and hard work. But Morgan Housel reminds us, luck and risk play a much bigger role than most of us realize. Take Bill Gates as an example. Everyone knows him as the genius behind Microsoft, but few pay attention to how much of his story began with the school he attended. In 1968, Lakeside School in Seattle, Washington, where Gates studied, was one of the very few high schools in America with a time-sharing computer terminal. Back then, computers were so rare and expensive that even top universities didn't have them. If Bill Gates hadn't had access to a computer at just 13 years old, would Microsoft exist today? It's hard to say. Warren Buffett, the world's fourth richest man, openly admitted, "If I had been born in a different country or in a different era, I might never have become an investor. I was simply lucky to be born at the right time in the right place." But luck is only half the story. Risk is always lurking too. Remember Lehman Brothers in 2008? It was one of the largest investment banks on Wall Street, with a history spanning 158 years. And yet, in just a few months, it collapsed completely, dragging the entire US economy into crisis. Thousands of employees lost their jobs. Millions of families lost their homes. For many, this wasn't a matter of personal mistakes, but systemic risk, something entirely outside their control. Housel uses these stories to emphasize a point. When you look at someone's success or failure, never separate luck and risk from the picture. A 2018 study from Stanford University analyzed thousands of billionaires and self-made millionaires in America. The results showed that beyond hard work and discipline, the timing of when they entered the market, whether during an economic boom or in a rising industry, was a decisive factor. In other words, a big part of success came down to being lucky in the historical moment. This leads us to an important lesson. Be humble in success and compassionate in the face of others' failures, because you never really know everything they've been through. Your success may carry the imprint of a unique opportunity others never had, and their failure may be the result of an unexpected risk they couldn't control. Housel's advice is clear. Instead of trying to copy a billionaire's story, learn to accept uncertainty. Understand that you can't completely eliminate luck or risk from the money game, but you can prepare your mindset. When you succeed, don't get arrogant. When you fail, don't get bitter. At the end of the day, money is not just about numbers. It's a game of probability, where luck and risk work together to shape our destiny. Key takeaway from this chapter: humility is the safety valve of financial thinking. It keeps you grounded when you win, and it keeps you from despair when you lose.
Part 3. The Power of Compounding. There's a famous story about Warren Buffett, the legendary investor everyone knows. Today, his net worth is over $100 billion. But here's the surprising part. Most of that wealth didn't come from brilliant, once-in-a-lifetime investments, as many people assume. It came from compound interest over time. Let me share a number that might shock you. Buffett began investing at just 10 years old. By the age of 30, he was already worth more than $1 million, a massive sum back in the 1960s. But the key is this: he didn't stop. He kept investing, letting money work for him decade after decade. And here's the most astonishing fact: 99% of Buffett's wealth was accumulated after he turned 50. What does this mean? If Buffett had started his investing career at 30 instead of 10, even with the same intelligence and skill, his fortune today would likely be just a fraction of what it is. In the world of finance, people are often obsessed with chasing high returns. They run after hot stocks, cryptocurrencies, or startups that might grow tenfold. But the truth is this: the rate of return matters far less than the amount of time you let your money grow. Imagine you have $10,000. If you invest it at 10% annual returns for 10 years, you'll end up with about $25,937. If you simply leave it for 30 years, it grows to $174,494. And if you stay patient for 50 years, it skyrockets to nearly $1.2 million. All because of one simple formula: compounding equals returns multiplied by time. A 2018 Fidelity report revealed a fascinating case. The investors with the best performing retirement accounts were often the ones who had actually forgotten they even had an account. They didn't withdraw, didn't trade constantly, they just left their money alone and let compounding work. By contrast, those who tried to outsmart the market with frequent buying and selling usually ended up with worse results. What makes compounding magical isn't complex math, it's patience. You don't need to be a genius or a market wizard. You simply need to put your money to work, nurture it, and let time transform small sums into massive wealth. Morgan Housel calls this the magic of patience. It's like planting a tree. In the first year, you hardly notice any change. But after 20 or 30 years, that same tree can shade an entire garden. The lesson? Don't just focus on chasing big short-term gains. What you really need is to start early, stay consistent, and let compounding do the heavy lifting. Part 4. Getting rich versus staying rich. Getting rich is one thing, but staying rich, that's an entirely different story, and often the harder challenge. Morgan Housel explains that to build wealth, you often need courage, a willingness to take risks, ambition, and even a bit of recklessness. But to keep wealth, the recipe is almost the opposite. You need humility, a healthy sense of fear, caution, and most importantly, the wisdom to know when to stop. Take lottery winners in America, for example.
studies show that more than 70% of jackpot winners end up broke within just 5 years. Why? Because they never learned how to manage and protect wealth. They assumed the money would keep flowing forever, so they spent recklessly, invested blindly, or became easy targets for people looking to take advantage of them. Staying rich requires a completely different mindset. It isn't about one brilliant decision. It's about discipline, repeated day after day. Warren Buffett once said that the reason he became one of the wealthiest people in the world wasn't just because he knew how to invest. It was because he never let himself go broke. One of his golden rules is rule number 1, never lose money. Rule number 2, never forget rule number 1. The 2008 financial crisis illustrates this perfectly. Many people who had been wealthy before the crash lost everything because of greed. They poured their money into high-risk bets, never knowing when to pull back. And when the market collapsed, their fortunes vanished in a matter of months. On the other hand, the people who remained truly wealthy weren't necessarily those who made the fastest gains, but those who still had their capital intact when the storm passed. The lesson here is simple but critical. To become wealthy, you need bravery, but to stay wealthy, you need prudence. Don't just ask yourself, how can I make more? Always ask, how can I make sure what I have today is still here tomorrow and continues to grow? Part 5. Freedom, the ultimate goal of money. If there's one thing we all truly crave from money, it's not supercars, mansions, or fancy dinners. The ultimate goal of money is freedom. Morgan Housel emphasizes this. True wealth isn't measured by the number in your bank account. It's measured by the control you have over your own time. Real wealth is being able to wake up in the morning and decide what you want to do, with whom you want to do it, and when you want to do it. That is the highest form of wealth. Consider a well-known study in the US on life satisfaction. Researchers found that once people earn enough to cover their basic needs, happiness doesn't increase much with higher income, unless that income brings more control over their time. A surgeon might earn $1 million a year, but if they're working 16 hours a day with no time for family, they'll likely feel trapped. Meanwhile, a teacher earning $60,000 a year, who has summers off and afternoons free to spend with his kids, may feel far more free and content. Another striking example is Ronald Reed, a gas station attendant in Vermont. He lived simply, saved diligently, and invested for the long term. When he passed away, he left over $8 million to charity. But what made him truly wealthy wasn't just the money. It was the fact that he lived life on his own terms, free from pressure, free from competition, choosing a life of peace and independence. The real insight here is this: we often think money will buy happiness, but in reality, money's greatest value is when it buys freedom. The freedom to rest when you're tired, the freedom to be with your family when they need you, the freedom to say no to things that go against your values. Housel's lesson is crystal clear. Make freedom your highest goal when it comes to money. Because at the end of the day, you don't live to prove your wealth to others. You live to experience peace and happiness in your own life.
Part 6. Saving, Humility, and the Surprises of the Future. One of the greatest secrets of lasting wealth isn't how much you earn, it's how much you keep. Saving is the foundation of financial freedom, and it comes down to two things: living with humility and preparing for life's inevitable surprises. In America, many high-income earners still end up drowning in debt. A software engineer in Silicon Valley might make $150,000 a year, but if they buy $1 million house, drive luxury cars, and live extravagantly, they'll have little left at the end of the month. Meanwhile, a middle-class family earning $60,000 a year, if they live modestly and save 30% of their income, can quickly build an emergency fund and invest for a more secure future. Morgan Housel emphasizes this point. Saving doesn't depend on your salary, it depends on your habits and humility. Too many Americans are trapped in the rat race. The more they earn, the more they spend, chasing validation and status. Yet the people who remain truly wealthy are often the most unassuming. Warren Buffett, one of the world's most famous billionaires, still lives in the same house he bought in 1958 for just $31,000. His fortune wasn't built solely on brilliant investments. It was built on humility and frugality. And then there's the future, always full of surprises. The 2008 financial crisis wiped out millions of jobs and homes because so many people live paycheck to paycheck without savings. The COVID pandemic told the same story. Those with strong emergency funds got through it far more easily, while those relying solely on monthly income struggled immediately. Saving isn't just about stashing money away. It's about buying security and buying the freedom of choice for your future. With a safety net, you no longer live in fear of every unexpected twist. Living humbly frees you from social pressure and allows you to focus on what really matters: freedom, security, and long-term happiness. The message is clear. Don't let your income define how wealthy you feel. Let your ability to save, your humility, and your preparedness for an uncertain future define it instead. Part 7. People and the paradox of money. Money seems simple. You earn it, you spend it, you save it, you invest it. But as Morgan Housel argues, in reality, money is a psychological game, and people themselves are the most complex part of that game. The paradox is this: we know rationally what we should do, yet our emotions often drag us in the opposite direction. Take the U.S. stock market during the 2008-2009 financial crisis. Millions of investors panicked and sold their stocks at rock-bottom prices. They knew, at least in theory, that staying invested would be wiser. But fear took over, leading to costly mistakes. A decade later, when the market had not only recovered but soared to new highs, many realized they had missed the chance to multiply their wealth, all because they couldn't master their emotions. Another paradox: we often judge someone's wealth by what we see, without knowing the hidden reality. In America, you might see a man driving a brand new Tesla Model S and living in a 5,000 square foot home and assume he's wealthy. The truth might be that he's buried in debt, making high interest payments every month. Meanwhile, another person drives a 10-year-old Toyota Camry, lives modestly, yet quietly holds $1 million in retirement accounts, something no one ever notices. Housel emphasizes, real wealth isn't what you flaunt, it's what you build quietly behind the scenes. That's the paradox of money. Society glorifies the visible, while true financial security lives in the invisible: patience, discipline, and sustainable habits. The story of Ronald Read is a timeless example. He was a gas station attendant in Vermont, living an unassuming life that made people think he had very little. But when he passed away at the age of 92, he left behind $8 million for charity and family. He didn't win the lottery, he didn't gamble on risky ventures, he simply lived humbly, saved consistently, and invested patiently in stocks for decades. His life is proof of the paradox. Those who are truly wealthy often don't look wealthy at all.
Part 8. The final lesson: money is a tool, not the goal. After all the stories, lessons, and paradoxes, Morgan Housel asks us to pause and recognize a simple truth. Money is only a tool. It is not the ultimate goal of life. In America, countless stories exist of billionaires who spent their entire lives accumulating wealth, climbing the Forbes list, acquiring more companies, buying more real estate. But in the end, they still face the same question: did I live for money, or did I use money to live better? Money cannot replace family, it cannot replace health, and it cannot buy genuine happiness. What it can do is serve as a means to achieve freedom, peace of mind, and the opportunity to live life on your own terms. Housel points out that many Americans rush into the wealth race as if money were the finish line. But the paradox is this: when they finally arrive,
they often feel empty because they turned money into the destination rather than the vehicle. Think of it simply. A car can take you from point A to point B, but it doesn't define who you are. Likewise, money can pay your mortgage, send your kids to school, care for your parents, and build a secure life. But if you treat money as the sole meaning of existence, you will never feel satisfied. And this is the book's greatest message. Let money serve your life. Don't let your life become a servant to money. True wealth isn't measured by the balance in your bank account. It's measured by the peace, freedom, and fulfillment that money, when used wisely, can bring. Dear friends, we've now reached the end of our journey through The Psychology of Money by Morgan Housel. Across 8 chapters, we've discovered that money is not just numbers. It's a game of emotions, of patience, and above all, of how we choose to view life. We've learned that true wealth isn't about how much you earn, but how much you keep. And most importantly, money should serve our freedom and happiness, not the other way around. When we understand this, we finally take control of money instead of letting it control us.
In the mid-1980s, while thousands of investment funds on Wall Street struggled to make even a 10% annual return, one man quietly achieved something almost unimaginable. Peter Lynch, the manager of Fidelity's Magellan Fund, delivered an average return of more than 29% per year for 13 consecutive years, turning a $1,000 investment into nearly $28,000. No magic formulas, no insider secrets, no supercomputer algorithms. He simply paid attention to what others overlooked. The stores you visit every day, the brands your kids are obsessed with, or the companies people in your neighborhood can't stop talking about. Peter Lynch believed that ordinary people, if they truly observe the world around them, can outperform the professionals on Wall Street. And his book, One Up on Wall Street, is the roadmap to doing exactly that, to understanding why the best investment opportunities aren't hidden on Wall Street, but right in your everyday life. In this video, we'll explore the 6 timeless investing principles of Peter Lynch, ideas that have helped millions of American investors rethink the way they see money, the market, and themselves. If you want to learn how to invest smarter, be more patient, and build lasting wealth over time, hit that like button and subscribe so you don't miss the journey through more classic financial wisdom like this. Part 1. Anyone can find investment opportunities around them. Peter Lynch never believed that only people in suits on Wall Street understood investing. On the contrary, he believed that ordinary people, if they paid attention, could see what the entire market overlooked. In 1977, Lynch went shopping at a local mall with his wife and teenage daughter. While he was mentally reviewing a list of stocks, his daughter pointed to a clothing store and said, "Dad, my friends and I all shop here. It's always packed." That store was The Limited. Lynch looked around. Long lines of customers, busy cash registers, and most importantly, enthusiastic, loyal young buyers. Instead of dismissing it, like most investors would, he got curious. He read the company's financial reports, talked to store employees, and realized it was a rapidly growing business. When he invested in The Limited, its stock price went up more than 10-fold. From that experience, Lynch distilled a simple but powerful philosophy. You don't need to be a genius to spot a great investment. You just need to open your eyes. You don't have to be brilliant to find investment opportunities. You just have to observe the world around you. He called it invest in what you know. Invest in what you understand, what you see, and what you believe in. A homemaker might notice which food brand is taking over the grocery shelves faster than any Wall Street analyst. A father might see his kids going crazy over a new toy before the big funds even start writing reports about it. A tech worker might spot the next popular software trend before it ever makes it to CNBC.
We, the people living in the real world, hold the most vivid real-time data long before the market catches on. And Lynch proved it with numbers. During his 13 years managing the Magellan Fund, he delivered an average annual return of over 29%, turning a $1,000 investment into more than $28,000, simply by observing what others ignored. Once you realize that every great investment starts from something ordinary, you begin to see the world differently. Every crowded coffee shop, every brand trending on social media, every product that genuinely excites you could be the seed of an extraordinary investment. For Peter Lynch, investing wasn't a contest for the smartest minds, it was a journey for those who could see, feel, and believe in what they truly understood best.
Part 2. Understand the business. Don't invest based on rumors. Peter Lynch once said, "Behind every stock is a company. Find out what it's doing." Behind every stock, there's a real business. Learn what it actually does. He believed that the biggest mistake investors make is putting their money into something they don't understand. They buy because a friend mentioned it, because the price is going up, or because they saw a catchy headline on CNBC, not because they understand the company's real value. Lynch once told a story about a friend who proudly said, "Peter, I just bought shares of this company called XYZ. Everyone says it's about to go to the moon." Lynch asked, "What does the company do?" His friend paused for a few seconds and replied, "Something in technology, I think?" Lynch laughed and said, "If you can't describe the company in 2 simple sentences, you shouldn't own it." That became one of his golden rules. If you don't understand the business, you can't understand the stock. And if you don't understand the stock, you're gambling, not investing. Remember this, a stock isn't just a blinking number on your screen. It's a piece of ownership in a real company, with products, customers, employees, and leadership. Lynch said you should invest as if you were buying the entire business. So, before you invest, ask yourself, how does it actually make money? What gives it a competitive advantage? Who are its loyal customers? And most importantly, do you believe in its future? Lynch often called this the scuttlebutt method, the on-the-ground research approach. He would visit stores, talk to employees, chat with customers, and observe what was really happening. No complex data models, just curiosity and time to understand the business from the ground up. A classic example was his investment in La Quinta Inns, a mid-range hotel chain. Instead of relying solely on financial statements, he went there himself, talked to managers, toured the rooms, and spoke with guests. He saw full bookings, efficient operations, reasonable prices, and a scalable model. That's when he knew he'd found a solid business worth investing in. The result? The stock multiplied several times, simply because he trusted his own eyes over market rumors. The financial markets are noisy, full of headlines, predictions, and sure win and grace from every direction. But Lynch believed that true understanding is the only filter that keeps you from getting swept away. When you deeply understand a company, you don't panic when its stock drops. You stay patient because you know you own something real, not a bubble. Investing isn't about who knows more rumors. It's about who understands better. And in a world where everyone chases the next hot tip, the one who truly understands their business is the one who's truly free.
Part 3. The 6 types of stocks and how to identify them. Peter Lynch once said, "There's no such thing as a good or bad stock, only stocks that are right or wrong for you." He realized that most investors don't fail because they pick the wrong company. They fail because they don't understand what kind of stock they actually own. To help people escape that confusion, Lynch divided stocks into 6 main categories, each with its own personality, like 6 different types of people at an investing party. And to succeed, you have to know who you're talking to. 1. Slow growers. These are the big, mature companies, the wise old men of the market. They no longer grow fast, but they still generate steady profits and pay generous dividends. Think of Coca-Cola, Johnson & Johnson, or Procter & Gamble. They won't make you rich overnight, but they'll let you sleep well during financial storms. Lynch invested in this group not to strike gold, but to protect his portfolio from volatility. 2. Stalwarts. These are large, stable companies with moderate growth and consistent earnings, like Pepsi, McDonald's, or IBM in its prime. He called them the workhorses of the stock market, not flashy, but reliable and strong. If you buy them during times of panic, when everyone else is fearful, even a small recovery can bring solid returns. 3. Fast growers. Lynch's personal favorite. These are smaller companies growing rapidly, often with a breakthrough product or an innovative business model. Think of Starbucks, Home Depot, or Tesla in their early years, little known yet growing revenues by 30 to 40% annually. But Lynch warned, don't just look at growth, look at whether it's sustainable. A company can grow fast for a few years, but without a true competitive edge, that bright light may fade just as quickly as fireworks. 4. Cyclicals. This is the group that confuses new investors the most. They rise when the economy is booming and fall sharply when the cycle turns down. Think of airlines, automakers, or steel companies like Ford, Delta Airlines, or Caterpillar. If you don't understand the industry's cycle, you'll end up buying at the top and selling at the bottom. Lynch often said, investing in cyclicals without understanding the cycle is like skydiving without looking down. 5. Turnarounds. These are companies that have fallen on hard times, sometimes even close to bankruptcy, but are rebuilding for a comeback. They're like wounded soldiers who might rise again. If they recover, the payoff can be 3, 5, or even 10 times your investment. But if they don't, you lose it all. Lynch invested in this group very carefully, only when he saw real evidence of change, not vague promises in the news. 6. Asset plays. These are the hidden gems, companies whose true value lies beneath the surface. They might own undervalued real estate, unrecognized oil reserves, or undisclosed investments. Lynch made big profits from companies whose stock prices reflected only the visible tip of the iceberg. But to find them, you need the eyes of a financial detective, someone who reads between the lines of annual reports. For Lynch, understanding these 6 types of stocks means understanding the essence of investing itself. Because wise investors don't buy everything, they choose the right battlefield. You can't expect the explosive returns of a fast grower and still sleep peacefully like you would with a slow grower. You can't buy a cyclical stock without bracing yourself for a fall. When you know exactly what type of stock you own, you stop being afraid of market swings. Because instead of asking, why is the price dropping, you calmly ask, has the company's real value changed? And that's the moment you stop being a market player and become a true investor.
Part 4. Don't try to predict the market. Focus on the business. Peter Lynch once joked, if you spend 13 minutes a year trying to predict the market, you've wasted 10 minutes. He wasn't just being funny. It was the hard truth learned by millions of investors on Wall Street, people obsessed with guessing the perfect time to buy or sell while forgetting the only thing that actually creates real wealth, the business behind the stock. Imagine walking into a giant supermarket called the stock market. Everywhere you turn, people are shouting, the price is going up, the price is crashing, the S&P is doomed, AI will change everything. All that noise makes you forget that behind every ticker symbol, there are real people running real companies, producing, selling, innovating, expanding, and creating genuine value. Lynch was asked hundreds of times, what do you think the market will do next year? His answer was always the same. I don't know, and I don't need to know.
He believed the market is temporary, but businesses are real. If you invest in a company with a product people love, strong management, and sustainable growth, the market will eventually recognize its true worth. Throughout his career, Peter Lynch managed Fidelity's Magellan Fund with an average annual return of 29% for over a decade, an almost impossible feat. What set him apart was simple. He didn't try to call tops or bottoms. He didn't chase headlines or listen to TV experts. Instead, he spent his time reading financial reports, visiting stores, talking to employees, customers, and managers. He wanted to understand one thing. Is this company really creating value? Do customers come back for more? Does it have a competitive advantage others can't easily copy? For Lynch, investing meant buying a small piece of a business you'd be happy to own for the next 10 years. If you wouldn't hold it for 10 years, don't hold it for 10 minutes. He once shared a story from the early 1980s recession, when the Dow Jones was in freefall and investors were running for the exits. But instead of panicking, Lynch quietly bought more shares of the companies he believed in, especially retailers that were still full of customers, even as the news screamed doom and gloom. The result? When the market recovered, the Magellan Fund didn't just bounce back, it multiplied. Because Lynch understood one thing: the market may be wrong in the short term, but true value always wins in the long run. Now, ask yourself, have you ever missed a great investment because you were afraid the market looked bad? Or sold too early because the news sounded scary? Peter Lynch would say that's the most common mistake of all. Humans crave control over the future, but investing is a game of accepting what you can't control. You can't predict when the market will rise, but you can choose businesses that will survive and even thrive when it falls. You can't control crowd emotions, but you can go against them with logic and facts. Lynch believed investing isn't about prediction, it's about observation. Observing how the real world works, how consumers behave, how businesses adapt. If you can do that, you don't need to know when the market will move up or down, because you've already placed your trust where it belongs, in real value, not in stock prices. And that's how Peter Lynch beat Wall Street, not with prophecy, but with understanding. Part 5. How to spot a great stock. Peter Lynch had a philosophy that sounded almost too simple to be true. The great stocks are not hiding in analyst reports. They're right in front of your eyes. To him, the stock market wasn't a casino for speculators. It was a mirror reflecting real life. Lynch believed that if you go grocery shopping, drive a car, stream Netflix, or use an iPhone every day, you already have an investment edge. Wall Street will never have real-world experience. He once shared that one of his most successful investments came from a shopping trip with his wife. While Lynch was busy checking stock prices, his wife noticed that a store called Legs, owned by Hanes, was always packed with women lining up to buy a new type of pantyhose. Curious, Lynch dug deeper. He read the company's financials and found that Hanes had strong margins, a fast-selling product, efficient management, and little to no debt. He invested. A few years later, the stock had multiplied several times over. Lynch concluded, a smart consumer can become a smart investor if they're willing to observe. According to Lynch, great stocks don't need to be flashy or filled with buzzwords like AI, blockchain, or metaverse. They often come from businesses you already understand, the ones you know exactly how they make money. A grocery store that operates more efficiently than its competitors. A small company with a must-have product that keeps customers coming back. A local brand quietly expanding nationwide. Those opportunities aren't hidden in Wall Street boardrooms. They're sitting right in your neighborhood mall. Lynch once said, I don't have to know everything about technology to invest in it. I just need to understand how a company makes a profit and why customers need them. That's why he categorized stocks into 6 groups, from stalwarts to fast growers, and searched for hidden gems in each one. To Lynch, a great stock doesn't have to belong to a perfect company. It just needs a solid growth story, reasonable valuation, and visionary management behind it. Take the modern world, for example. An average American starts the day with Starbucks, pays with Apple Pay, shops on Amazon, and unwinds with Netflix at night. Each of those behaviors is a signal, an investment clue Peter Lynch would want you to notice. Because before Wall Street analysts discover a trend, consumers have already lived it millions of times. However, Lynch always reminded investors, invest in what you know, but make sure you truly know it. Understanding doesn't mean I like the product. It means you understand the business model, the profit margins, the risks, and why others haven't seen the opportunity yet. A great stock isn't a hot one. It's one that's undervalued compared to its true worth. He often compared investing to planting a tree. If you pick the right seed, plant it in good soil, and water it patiently, it will grow on its own. The problem, he said, is that most people keep digging up the seed every week to see if the roots are growing. Great stocks take time, sometimes 5, 10, even 20 years to show their real value. Lynch believed that patience is the most underrated superpower on Wall Street. In a world obsessed with chasing trends, Peter Lynch chose to move slow in order to go far. He didn't chase shooting stars. He looked for steady flames. Because, as he put it, a great stock doesn't have to amaze you every day, but after 10 years, it'll make you grateful you didn't sell it too soon.
Part 6. Discipline, Patience, and Faith in Reason. Peter Lynch once said, "Investing is not a game of intelligence, it's a test of emotions." During his 13 years managing the Magellan Fund, Lynch witnessed one of the strangest truths on Wall Street. The smartest people often made the least money. Not because they lacked knowledge, but because they lacked discipline and patience. He observed that most investors don't fail because they pick the wrong stocks. They fail because they can't handle how slow success really is. They buy when they're excited and sell when they're scared. They want to get rich quick, but the market only rewards those who are willing to get rich slowly. Lynch often compared the stock market to 2 kinds of people, a farmer and a gold digger. The farmer plants seeds, tends the soil, and waits patiently for harvest. The gold digger jumps from one pit to another, only to realize he never dug deep enough to find anything. A smart investor, Lynch said, must learn to live like the farmer. In the 1980s, when the market swung wildly and thousands panicked into selling, Lynch didn't flinch. He believed that chaos is the companion of the rational mind. While the crowd ran away, he quietly bought more shares of the companies he knew best. Businesses still making money, still growing, just temporarily hated by the market. The result? The Magellan Fund grew an average of 29% a year, crushing every competitor and becoming the most successful mutual fund in America. Lynch understood that in the short term, the market runs on emotion, but in the long term, it always returns to reason. A stock's price can drop 50%, but the real value of a business doesn't change because of a tweet or a nightly headline. Once you truly understand that, fear turns into opportunity. He often said, "No one can predict what the market will do in 6 months, but in 10 years, good companies will be worth more. That's a certainty." That belief became his competitive advantage, turning patience into power. While others chased new strategies, Lynch returned to the timeless ones. Understand the business, buy when the value is greater than the price, Hold long enough for results to speak for themselves. Peter Lynch didn't just teach how to pick stocks. He taught how to choose your attitude. In investing, everything changes. Interest rates, trends, politics, technology. The only things you can truly control are your discipline and your reason. And Lynch believed that patience isn't about waiting. It's about keeping faith when everyone else has lost theirs. Imagine this. If you had invested $10,000 in the Magellan Fund when Lynch started and held it until he retired, you would have had over $280,000. Not because of luck, but because one man refused to panic when the market did. Lynch once concluded, "Emotion is the investor's worst enemy. Reason, discipline, and faith in time, those are your three best friends on the road to success." When Peter Lynch retired at the age of 46, he had achieved something very few people on Wall Street ever could. Not just extraordinary profits, but true clarity. He didn't leave because he ran out of ideas. He left because he understood a lesson that most people spend their whole lives chasing but never truly learn. Money is not the goal. It's the result of living by your principles. For 13 years, Lynch never tried to beat the market. What he really conquered was himself. Because in the world of investing, the ultimate winner isn't the smartest person in the room. It's the one who stays faithful to reason even when the whole world goes the other way. If there's one message One Up on Wall Street was meant to leave behind, it's this. You don't have to be a genius to succeed. You just have to observe a little closer, understand a little deeper, and believe a little stronger in the real value you see. Because the greatest investment opportunities aren't found in financial reports. They're found in your ability to stay calm when everyone else is losing control.
The stock market today feels like a giant coin toss. AI is trading faster than the speed of light. Crypto swings like a roller coaster, and the news changes every single hour. And if you feel like you can't predict what's going to happen next, congratulations. You're finally seeing the world the way it really works. More than 50 years ago, Burton Malkiel, an economics professor at Princeton, said the same thing in his classic book, A Random Walk Down Wall Street. He made a statement that many people on Wall Street absolutely hated to hear. Even a blindfolded monkey throwing darts at a list of stocks could beat most professional investors. Why? Because the market is random, and almost no one can consistently outperform it in the long run. Not because you're not smart enough, but because you're playing a game where all the information is already priced in, long before you even read about it in the news. This book doesn't teach you how to predict the future. It teaches you how to survive and even win in a world that's unpredictable through logic, discipline, and time. If you've ever felt lost among 1,000 get-rich-quick strategies, or if Wall Street seems like a casino only the lucky ones win, stay until the end of this video, because a random walk down Wall Street will show you that success in investing doesn't come from being smarter than others, it comes from being more patient than everyone else. And don't forget to hit like, subscribe, and join me in the next book summary, so together we can reach true financial freedom. Part 1. The market is random, and no one can predict its direction. Burton Malkiel opens his book with a shocking idea. Stock prices don't follow any predictable pattern. They move like a drunken man taking a walk. You can't tell whether his next step will be to the left or to the right. From that, he introduces the concept of a random walk, a random stroll down Wall Street. It means that every piece of information, every expectation, every bit of news, whether good or bad, is instantly reflected in stock prices. No one, not even top analysts or billion-dollar hedge funds, can consistently predict where the market will go next. Sounds pessimistic? Not really, because that very randomness is what creates fairness in investing. You, an ordinary investor with a small account, still have a chance to win if you truly understand the nature of the game. Think back to 2021, when the GameStop and AMC frenzy shook Wall Street.
Retail investors on Reddit managed to beat big hedge funds, sending stock prices soaring by dozens of times in just a few days. But only weeks later, most of them lost all their profits. Not because they were stupid, but because they confused luck with skill, the emotional waves of the crowd with the real value of the market. The same thing is happening today with crypto, AI stocks, and meme coins in 2025. A single tweet, a viral TikTok video, or one speech from the Fed can send the entire market skyrocketing or crashing within hours. People think they're reading the market, when in truth, they're just surfing on randomness. Malkiel wants you to understand one simple truth. No one can predict the future. Even Warren Buffett doesn't know whether Apple stock will go up or down next week. What he does know is the intrinsic value of a company and the power of patience. The market doesn't reward those who are the fastest or the smartest. It rewards those who are steady, who know what they're doing, and who accept randomness as a natural part of the game. As Malkiel wrote, "There is no map for a random road, but there is a compass. And that compass is the right mindset."
Part 2. Bubbles and the Illusion of Investing. Burton Malkiel once said, "Every generation believes it has found a new way to get rich faster, and every generation ends up learning the same old lesson again." To him, the history of finance is an endless cycle of bubbles, where greed, fear, and illusion take turns steering human behavior. Look back over the past few centuries. In 1637, Europe went crazy over tulips. The price of a single bulb could buy a house in Amsterdam. Hundreds of years later, we repeated the same mistake, only under new names. In 1999, it was the dot-com bubble. In 2008, the housing crisis. In 2021, the crypto and meme stock frenzy. Malkiel called this rational madness, because deep down, everyone knows the risk is there, yet they still jump in, terrified of missing out. What makes bubbles dangerous isn't how fast prices rise, it's the crowd psychology behind them. When everyone around you is talking about a certain stock, coin, or can't-lose ETF, your brain starts whispering, maybe this time is different. But as Malkiel showed through centuries of data, it never is. Bubbles always inflate on hope and burst on reality. The only thing that changes is the name we give them. In the world of 2025, technology makes bubbles form faster than ever. AI trading, social media, and finance influencers have turned investing into a stage for collective emotion. A single TikTok video with the hashtag #GetRichQuick can send millions of people chasing the same penny stock or some unknown token. Today, the market doesn't just move on data, it moves on views. But as Malkiel reminds us, technology doesn't change human nature. Greed, fear, and FOMO remain the three most powerful engines of loss. Malkiel once wrote, "No one knows when a bubble will burst, but anyone can tell when they're inside one, if they're honest with themselves." That's the lesson he wanted every investor to remember. Ask yourself, is the value you're buying based on real earnings or just on the hope that someone else will pay more later? When your answer leans toward the latter, it's time to stop. In the end, he reminds us that wise investors don't chase the noise of the market. They step back, observe, and wait patiently for real opportunities. Because while the crowd is busy trying to beat Wall Street, those who truly understand randomness focus on just one thing: not getting caught in the illusion. Part 3. Stocks remain the most profitable asset in the long run. If there's one thing Burton Malkiel believes with absolute conviction after more than half a century of watching the markets, it's this: no investment vehicle outperforms stocks over the long term. Through wars, crises, recessions, and bubbles, stocks have consistently been the safest ticket to beat inflation and build real wealth. Just look at the past 100 years of American history. Since 1928, the U.S. stock market, represented by the S&P 500, has delivered an average annual return of around 9 to 10%, despite the Great Depression of 1929, World War II, the dot-com bubble, the 2008 financial crisis, and even the COVID crash of 2020. Malkiel compared stocks to a roller coaster. They can make you dizzy in the short term, but the wheels are always tilted upward in the long run. Investors who understand this don't panic when prices fall, because they know the market never stays down forever. After every crash, America always rebounds stronger. Technology advances, productivity rises, businesses innovate. And that constant innovation is what drives stock prices higher, decade after decade. Malkiel often illustrated this with a simple example. If you had invested $10,000 in the S&P 500 back in 1970 and simply left it there until 2025, your portfolio today would be worth over $2 million, even after living through every major market crash. But if you had tried to time the market, jumping in and out to avoid downturns, missing just the 10 best days of returns would have cut your profits almost in half. The market rewards patience, not short-term cleverness. Today, many Americans are drawn to new types of investments, from crypto to tech startups, from AI stocks to meme stocks. But Malkiel reminds us the core principles of investing never go out of style. A diversified, low-cost portfolio focused on long-term equities remains the simplest and most reliable path to real wealth. He calls this journey a random walk, because you can't know where stock prices will go tomorrow. But if you keep walking long enough, that path almost always leads upward. And that's the quiet magic of stocks. Their power doesn't lie in sudden leaps, but in the steady compounding of time.
Part 4. Why most investors lose money. Burton Malkiel once said, "The market isn't unfair. It simply punishes those who don't understand how it works." That simple statement explains why most investors, despite good intentions, still end up losing to the market. Not because they're not smart, but because they're too human. Imagine it's 2020. The market has just crashed due to the pandemic. Every headline screams panic. The economy is collapsing. Stocks in free fall. Terrified, many people rush to sell everything, believing they are, quote, protecting their assets. 6 months later, the market rebounds sharply, and they watch from the sidelines, regretful, confused, until they jump back in at much higher prices. That cycle of emotion is what Malkiel calls the behavioral paradox. People tend to buy when they feel safe and sell when they feel scared, which is exactly the opposite of what they should do. But emotion isn't the only problem. Malkiel also points to another common disease, the illusion of control. Most investors believe they can pick stocks better than average or time the market to catch the, quote, top and bottom. But decades of research prove otherwise. Over 90% of actively managed funds fail to outperform the market index in the long run. Even the most skilled managers are eventually beaten by randomness, the market's built-in unpredictability. One famous example is the Dalbar study, an annual report tracking the performance of U.S. investors. Over a 30-year period, the S&P 500 returned an average of over 9% per year, yet the average individual investor earned only 3 to 4%, not because of fees or taxes, but because of bad timing. They were fearful when they should have been patient and greedy when they should have been cautious. Malkiel says to win, you don't need to be smarter than Wall Street. You just need to be calmer, because the market is simply a place where money moves from the impatient to the patient. And in the world of investing, the winners aren't those who predict the future, but those who can endure the present. Look at the great examples: Warren Buffett, Jack Bogle, and others. They never tried to beat the market. They stayed disciplined, bought quality assets, and let time do the heavy lifting. That's why they became wealthy, not because they were lucky, but because they mastered themselves. Part 5. The Solution: Index Funds and Diversification. Burton Malkiel once said, "If you can't predict the future, own the whole future." That's the philosophy behind index funds, a simple yet powerful solution that outperforms most of Wall Street's complex strategies. Think of it this way: instead of trying to pick a single, quote, winning stock, you buy the entire market, like betting not on one horse, but on the whole racetrack. When some companies fail, others rise to take their place, and the index keeps climbing. Over time, you don't have to be right, you just have to stay invested long enough. Malkiel revealed a fact that many investors still find hard to believe. A low-cost index fund that mirrors the S&P 500 typically outperforms 80 to 90% of actively managed funds in the long run. The reason is simple: lower fees, fewer mistakes, and smaller tax drag. When you're not paying hefty management fees every year, your money keeps compounding, creating that exponential growth Albert Einstein famously called the eighth wonder of the world. Here's a simple illustration. Two investors, Alex and Jamie, start at the same time. Alex invests in an active fund with a 1.5% annual management fee. Jamie chooses an S&P 500 index fund with just a 0.05% fee. After 30 years, with the same initial investment and the same market returns, Jamie ends up with over 25% more wealth than Alex, simply because she didn't let fees quietly eat away at her gains. And it's not just about stock indexes. Malkiel emphasizes the importance of global diversification, mixing U.S. and international equities, bonds, REITs, and even non-traditional assets. By spreading across different asset classes, you don't just reduce risk, you stabilize returns. He compares diversification to not putting all your eggs in one basket, but also warns it's useless to have many baskets if they're all in the same truck heading downhill. True diversification means owning different types of assets, not just funds with different names. It's just like in life. You can't control every event, but you can build a strong structure that stands firm through any storm. And in investing, that structure is made of 3 pillars: low-cost index funds, diversified allocation across time, regions, and asset classes, and long-term discipline. Malkiel isn't asking you to gamble. He's showing you that you don't need to beat Wall Street's game at all, because you can win, not through genius, but through consistency and simplicity.
Part 6. Smart Asset Allocation Through Every Stage of Life. Burton Malkiel once said, "There's no single investment strategy that's right forever, only the one that fits your stage of life." To him, investing isn't about chasing the highest returns at any cost. It's about finding the right balance between risk and peace of mind. Let's start with someone young, say Ethan, 25 years old, fresh out of college. His income might still be modest, but he owns something that even billionaires can't buy: time. Malkiel reminds us that at this age, short-term risk doesn't matter. The real danger is being afraid to take any risk at all. That's why a young investor's portfolio should lean heavily toward stocks, especially broad-based index funds like the total market or S&P 500. In a few years, prices might fluctuate wildly, but over a few decades, history has proven that stocks always win. As you move into your 40s and 50s, priorities shift. Now it's less about building wealth from scratch and more about protecting what you've earned. You may have a family, children, and bigger financial responsibilities. Malkiel suggests gradually increasing exposure to bonds and other stable assets, not because you've become more fearful, but because you're getting closer to a point in life where you can't easily start over. At this stage, wisdom means balance. Keep enough stocks to let your money keep growing, but enough bonds to anchor your portfolio when markets shake. And by the time you reach your 60s and beyond, when retirement is no longer a distant idea, Malkiel advises focusing on preservation and sustainable withdrawals. But he also warns against pulling out of the market entirely. Even at 70, people may live another 20 to 30 years, and inflation remains a silent enemy. That's why he offers a simple but time-tested rule of thumb. Stock allocation equals 100 minus your age. So at age 60, you might hold 40% in stocks and 60% in bonds, a balanced approach that is held up through countless economic cycles. He also recommends target date funds, which automatically adjust your asset mix as you age, giving ordinary investors a professional-grade strategy without the complexity of constant rebalancing. For those with larger portfolios, adding REITs, international stocks, and inflation-protected bonds, or TIPS, can further strengthen and stabilize returns in any market environment. What Malkiel wants us to understand is this: investing isn't just about numbers, it's about walking alongside life itself. Youth is the season for planting seeds, midlife is for nurturing and protecting them, and retirement is the harvest. But even then, you must keep a few seeds for the future. Because, like the market, life never stands still. Those who know how to allocate wisely don't just maximize returns, they buy something far more valuable: peace of mind and financial freedom through every chapter of life. Part 7. The warning about new myths, technology, AI, and crypto. When A Random Walk Down Wall Street was first published in 1973, the internet didn't even exist yet. But interestingly, Burton Malkiel had already predicted something that remains true more than half a century later. Every generation believes it has found a shortcut to wealth, but in the end, the only real path is patience. In the 1990s, American investors were swept up in the dot-com frenzy. People poured money into any company with .com in its name, convinced that the internet would change everything. And yes, the internet did change the world, just not for everyone. When the bubble burst, the Nasdaq plunged nearly 80%, and millions of investors were wiped out. 2 decades later, history repeated itself, just with new names: AI, crypto, NFTs, the metaverse. The stories sound different, but human psychology stays exactly the same. Malkiel called this phenomenon the new myth, the collective illusion where crowds convince themselves that this time is different. And once again, greed takes the wheel while reason gets left behind. Think back to 2021, when Bitcoin soared past $60,000. YouTube channels, podcasts, and Twitter, now X, were flooded with voices proclaiming this is the future of finance. Many Americans mortgaged their homes, emptied retirement accounts, and rushed to get in before it's too late. But just a year later, after the collapses of FTX, Celsius, and Luna, that dream crumbled. Malkiel never opposed technology. He once said, "Technology can change the world, but it cannot change human nature." In other words, investing in AI or blockchain isn't wrong. It only becomes dangerous when you chase price instead of value. He urged investors to distinguish between real innovation and crowd-driven speculation. If you believe in the future of AI, invest through index funds that include real, profitable innovators like NVIDIA, Microsoft, and Alphabet, not random tokens with no fundamentals. If you believe in crypto, treat it as a small, diversified position, not an all-or-nothing gamble. And if you ever feel that fear of missing out creeping in, remember, the market will always give you a second chance as long as you still have both money and reason. After more than 50 years, Malkiel's message hasn't aged a bit. Technology changes fast, but the laws of greed and fear never do. Don't become a victim of a new myth wrapped in the language of modern innovation. Because in the end, the random walk he spoke of wasn't about the market's luck, it was about a timeless truth. No one knows the future, but the disciplined will always outlast the dreamers. Closing, a timeless lesson. For more than half a century, A Random Walk Down Wall Street has remained a survival guide for every investor, not because it teaches you how to get rich quickly, but because it teaches you how not to destroy yourself on the road to wealth. Burton Malkiel once said, "Investing isn't a race against other people, it's a journey where you learn to master yourself." In this age of AI, crypto, and constant technological hype, the hardest thing isn't finding the next winning stock, it's keeping your sanity when everyone else is losing theirs. Because in the end, True wealth doesn't come from predicting the market. It comes from understanding yourself.
Imagine this. One day, you no longer need to set an alarm for 7 a.m. to rush off to work. No more worrying about utility bills piling up at the end of the month. You wake up, make a cup of coffee, open the window, and realize you are free. Free with your time. Free to choose. Free to live life on your own terms. Sounds far-fetched? J.L. Collins says the path to that freedom isn't complicated. You don't need to be a financial genius, you don't need risky investments, and you definitely don't need to grind away for 80 hours a week. Everything comes down to one simple road, the simple path to wealth. And in this video, we'll walk step by step along that path together. If you truly want to find financial freedom for yourself, hit like, subscribe, and turn on the notification bell right now, because the books I summarize here just might change your life. Part 1. The foundational mindset about money. The very first thing J.L. Collins wants us to understand is this: money isn't just numbers in a bank account. Money is freedom. It's choice. It's a shield that allows you to live a life with less stress and more meaning. He once told his daughter, "Every dollar you earn, if you save it and invest it wisely, becomes a little soldier working for you. And one day, an entire army of dollars will be fighting to protect you instead of you having to work so hard just to survive." Imagine this. You have $100. If you spend it all, it's gone. But if you save and invest it, that money starts to grow like a seed that sprouts into a tree, producing fruit year after year. These money trees are the real source of financial freedom. Collins also points out a hard truth. Most people are becoming slaves to money without even realizing it. They work to spend, then spend and have to work even more. The cycle never ends. Only when you change your mindset, seeing money as a tool for freedom rather than a tool for endless consumption, do you actually step on to the path to wealth. Here's a simple example. If you spend $5 a day on fancy coffee, in 10 years, you'll have spent nearly $20,000. But if that same money were invested in an index fund averaging 7% growth per year, you could have over $28,000. One small habit can determine whether you stay a slave to money or make it your ally. The core mindset Collins teaches is this: let money work for you instead of you working for money forever. And that's the very first building block on the simple path to wealth. Part 2. Save more than you think you need. One of the key truths J.L. Collins emphasizes is this: saving is the foundation of all wealth. You can't invest without capital, and you can't build capital without saving. Most people assume saving 5% or 10% of their income is enough, but Collins is blunt. That's far too little. If you truly want financial freedom, you should aim to save at least 30% and even 50% of your income if you can. That may sound extreme, but think about it. If you save just 10% of your income, you'll need to work almost 50 years before you can retire. But if you save 50%, you could retire in just 15 to 20 years. The difference comes from a simple principle. The more you save, the less you actually need to maintain your lifestyle, and the faster you reach financial independence. Here's a practical example Collins gives. Imagine someone earning $60,000 a year. If they save only 10%, $6,000, they're spending $54,000 annually. To retire, they need to accumulate enough to cover that lifestyle, a huge number. But if they save 50%, $30,000, their annual spending drops to $30,000. That means, following the 4% rule, they only need to build 25 times that annual spending to retire, making early retirement much more achievable. The key takeaway here isn't about how much you earn, but how much you actually need to live comfortably. Living below your means and saving aggressively is the ultimate shortcut to freedom. And Collins makes an important clarification. This doesn't mean living miserably or cutting out all joy. It means spending consciously. Ask yourself, does this expense truly bring me value and happiness, or is it just habit and impulse?
With discipline around money, you'll realize real happiness doesn't come from buying one more thing. It comes from the peace of mind that you're moving closer to financial independence.
Part 3. The Simple Path. Index Funds. J.L. Collins has one piece of advice that might sound too simple to be true, yet it's the very investment strategy that has helped millions of Americans achieve financial independence. Invest in low-cost index funds, especially those tracking the S&P 500 or the total U.S. stock market. Why index funds? Because instead of trying to pick stocks, time the market, or follow the latest broker's tip, an index fund automatically buys you a basket of hundreds or even thousands of the largest companies in the market. That means you don't need to be smarter than Wall Street. You don't need to guess which company will be the next superstar. All you need to do is own the entire market. Collins points out a truth that many people don't want to admit. Most actively managed funds fail to beat the market over the long run. Sure, a few managers may outperform for a year or two, but over 10 or 20 years, the majority fall behind. Meanwhile, passive index funds quietly win thanks to ultra-low costs and consistent performance. Take a real example. The Vanguard 500 Index Fund, founded by Jack Bogle himself, charges an expense ratio of just 0.04%, basically close to nothing. By comparison, many actively managed funds charge 1% or more. That difference may sound small, but over 30 to 40 years, those fees can eat away hundreds of thousands of dollars from your wealth. Index fund investing is not a get-rich-quick scheme. It won't double your money overnight. What it does offer is far more valuable: reliability, stability, and sustainable long-term growth. History shows that over time, the U.S. stock market has delivered an average return of about 7 to 10% per year after inflation. Put simply, instead of betting on a few horses, you're betting on the entire race, and in the long run, that race almost always goes upward. This is the simple path Collins emphasizes. Save aggressively, invest consistently in low-cost index funds, be patient, and let time and compound growth do the heavy lifting. Simple, clear, effective, without the need for any complicated tricks. Part 4. The Power of the Stock Market. To many people, the stock market feels like a risky gamble. Stock prices rise and fall every day, and the news is always filled with panic whenever the market bleeds red. But J.L. Collins urges us to look beyond the short-term noise and see the bigger picture. Over the long run, the stock market always goes up. Take history as an example. If you had invested $10,000 in the S&P 500 back in 1975, that money would be worth over $2 million today, all without you lifting a finger, other than simply leaving it invested. Of course, along the way you would have endured sharp downturns: the dot-com bubble, the 2008 financial crisis, the COVID-19 crash of 2020. Yet every single time, the market recovered and climbed to new heights. Collins calls this the magical power of the stock market. It's not perfect in the short term, but in the long run, it's the most powerful wealth-building machine humanity has ever known. Here's the key. The U.S. stock market reflects the strength of hundreds, even thousands of the world's leading companies. When you invest in an index fund, you're not betting on a single business. You're investing in the entire U.S. economy, in human creativity, innovation, and growth. And remember this: market crashes are not disastrous. They're opportunities. When stock prices drop, you're essentially buying valuable assets at a discount. Just like a 50% off sale, downturns are the best time to accumulate more, so that when the market rebounds, your gains multiply. That's why Collins stresses, don't let emotions control you. Don't panic and sell when the market plunges. Instead, stay calm, be patient, and trust the long-term trend. If the power of the stock market could be summed up in one line, it would be this: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. In other words, the crowd may push prices up and down in the moment, but real value always wins, if you give it enough time. Part 5. Avoid debt, the enemy of wealth. If the stock market is the engine that built your wealth, then debt is the hole that drags you backward. J.L. Collins doesn't sugarcoat it. Debt is the single greatest enemy of wealth. Take credit cards, for example.
In the US, millions of people are burdened with credit card debt carrying interest rates of 18 to 25% per year. What does that mean? It means you're paying the bank far more than what you could realistically earn in the stock market. While the market may give you 7% a year, credit card debt is draining 20%. You can't win a game where your opponent always takes more than you make. Colin's advice is blunt. Never carry credit card debt. And if you're already in debt, treat paying it off as an emergency. The faster you eliminate it, the sooner you break free, allowing your money to work for you instead of for the bank. And it's not just credit cards. Collins warns against car loans and consumer debt as well. That shiny new car might give you the illusion of wealth, but in reality, it's a depreciating asset, losing value every day, while the debt tied to it keeps growing. Of course, not all debt is inherently bad. A reasonable mortgage, for instance, can be considered good debt, since real estate often appreciates over time. But even then, Collins advises borrow as little as you can and pay it off as quickly as you can. Stretching a loan over decades means losing hundreds of thousands of dollars in interest, money that could have been invested to grow your wealth. The message here is crystal clear. Debt is bondage. It strips away your freedom, your choices, and makes you a servant to money. On the other hand, being debt-free means being free. Free to invest, free to choose your own path, and free to live a life unchained from monthly bills. If you truly want to build lasting wealth, remember this. Hate debt the way you would hate an enemy. Part 6. The 4% rule for retirement. Imagine this. You've spent your whole life saving and investing. Now your portfolio is big enough and you're ready to step into retirement. The big question is, how do you withdraw money without running out? This is where the 4% rule comes in. The rule is simple. Each year, you withdraw just 4% of your total invested assets to cover living expenses. The other 96% stays invested, continuing to grow, and with the market historically growing around 7% annually. Your wealth is not only preserved, it can even keep increasing. The beauty of this is that you don't have to sell everything or worry about eating into your principal. Instead, your assets keep working for you, even after you've retired. Collins emphasizes that financial freedom doesn't necessarily mean never working again. It means reaching a point where you don't have to work unless you choose to. That choice, that freedom, is the real goal. The 4% rule acts like a roadmap. It helps you figure out how much you need each year to live comfortably, and from there, calculate the total amount of wealth you need to reach financial independence. For example, want to live on $50,000 a year? You'll need about $1.25 million invested. Want $100,000 a year? You'll need about $2.5 million. Those numbers might sound huge, but remember, with disciplined saving, steady investing in index funds, and the power of time, they are completely achievable. Collins's most important message is this. You don't need a lottery win or $1 million salary. With patience, discipline, and a simple plan, you can retire early and live in comfort for the rest of your life.
Part 7. Financial freedom as the ultimate goal. Picture this. You wake up one morning, open your eyes, and realize, today, you don't have to go to the office. You're no longer tied to a demanding boss. You're no longer stuck working a job just to pay the bills. Instead, you can choose to spend the day taking your kids to school, reading your favorite book, traveling, or starting a project you truly care about, even if it doesn't make much money. That is financial freedom. According to J.L. Collins, money itself is not the destination. Money is just a tool, and when you use it wisely, that tool unlocks the most powerful thing of all: choice. The choice to work or not work. The choice to pursue your passions instead of chasing jobs you hate. The choice to live life on your terms rather than under the weight of bills and debt. Many people believe financial freedom is only for the rich, but Collins proves that anyone, even with an average income, can achieve it as long as they save diligently, invest simply, and remain patient with time. The key is this: the earlier you start, the sooner you reach freedom. And once you do, you discover that the real value of financial independence isn't in having more money. It's in having the ability to live a full, meaningful life completely on your own terms. In the end, J.L. Collins' message is simple, yet powerful enough to change your entire life. Money isn't for showing off. It's not for chasing endless races. Money is for freedom. Freedom to live, freedom to choose, freedom to be in control of your own life. The path to wealth is not complicated. Earn money, save diligently, invest in index funds, and let time and compound growth do the work for you. No secret hacks, no high-risk bets. Just discipline, simplicity, and faith in the process. And the best part? You have the power to start today with small, steady decisions. Every step, no matter how small, brings you closer to financial independence.
Have you ever wondered why so many Americans work hard their entire lives, save every penny, and still end up struggling to live comfortably in retirement? Sounds familiar? Most of us believe that to build wealth, we need to outsmart the market, pick the right stocks, or time it perfectly. But the truth is, most people don't fail because they're not smart enough. They fail because they lack patience and a simple, consistent strategy. In Just Keep Buying, Nick Maggiulli delivers a crystal-clear message. Stop trying to predict the market, stop waiting for luck, just keep buying, stay disciplined, and let time do the heavy lifting for you. This isn't some far-fetched theory. It's a method that has been proven over decades in the real world. So, if you want to learn how to turn every small dollar into a bigger opportunity and build lasting wealth over time, this video is for you. And before we dive in, make sure to hit like and subscribe so you don't miss more life-changing books on money and mindset. Part 1. Earning and Saving. Nick Maggiulli emphasizes that before you even think about investing, you need to build a steady stream of income and learn how to save wisely. It sounds simple, but this is the crucial step that many people overlook. Too often, we get caught up chasing the smartest investment tricks or the next get-rich-quick scheme, forgetting that without money to invest, none of it matters. The core idea here is this. You don't need to live extremely frugal, but you do need to save consistently and stay disciplined. Maggiulli calls this building a strong financial foundation. The more money you have available to invest, the greater your opportunity to let compounding work its magic over time. Here's a relatable example for many Americans. Let's say you work a 9-to-5 job and earn $4,000 a month. Instead of just leaving your paycheck in a bank account and spending freely, you could set aside 15% every month for investing, while also looking for ways to grow your income, like learning new skills, picking up freelance projects, or exploring small business opportunities. After just a few years, that discipline of saving and boosting your income could give you a solid investment fund without gambling on hot stocks or Bitcoin. Another powerful example comes from the COVID-19 era. Many people lost their jobs, but instead of waiting around for unemployment checks, some used that time to learn new online skills and earn extra income through platforms like Etsy, Fiverr, or even TikTok. Those small amounts of money, when saved and invested consistently, became a financial cushion that not only helped them survive the crisis, but also set them up for long-term growth. The key takeaway from this section is simple. Before thinking about investing or getting rich quick, make sure you've created a steady cash flow and developed disciplined saving habits. This is the very first step, the foundation that makes Maggiulli's principle of just keep buying possible. Buy consistently and let time do the rest for you. Part 2. Consistent investing, also known as dollar cost averaging. Nick Maggiulli emphasizes that one of the most powerful principles for building lasting wealth is investing consistently, no matter whether the market is up or down. This is the strategy known as dollar cost averaging, or DCA. Instead of trying to time the market and buy at the bottom, you simply invest a fixed amount on a regular basis, letting the ups and downs average out over time. Why does this work so well? Because the stock market is impossible to predict with precision, and most attempts to buy the dip or sell at the top end in failure. By sticking to a steady schedule of investing, you can steadily grow your wealth without the stress of guessing the market and reduce the risks that come with short-term volatility. Here's a real-world example. Warren Buffett, the legendary investor, has often said that his best advice for most people is this: just buy an S&P 500 index fund regularly, no matter what the market is doing, and let time do the rest for you. Buffett doesn't rely on predicting the market. He relies on patience and long-term compounding. Now, let's look at an everyday example that's closer to home. Chris, an office worker in Denver, set aside $200 a week into an index fund starting at age 25. Through the 2008 financial crisis and the COVID-19 crash in 2020, he never stopped his regular contributions. By the time Chris turned 35, his portfolio had grown several times, giving him the financial foundation to buy a home and even start a small business. Maggiulli's point is clear. You don't need to outsmart the market or chase hot stocks. All you need is persistence. By consistently investing, the average returns over time will make you the winner. The principle of just keep buying represents patience and the power of time, two forces that most people underestimate. Key takeaway: sustainable wealth doesn't come from luck or clever tricks. It comes from steady contributions, patience, and letting time work in your favor.
Part 3. Cash and Investing. Nick Maggiulli stresses that while it's important to keep some cash on hand for emergencies, you shouldn't let too much of your money just sit idle. Inflation eats away at purchasing power over time. Your cash should act as a safety net for unexpected events like job loss, home repairs, or sudden medical bills, while the rest should be invested so your money can grow. Here's a real-world example. Suze Orman, one of America's most well-known personal finance experts, has long recommended that every household keep 3 to 6 months of living expenses in an emergency fund. She once shared the story of a client who suddenly lost their job, but because they had that cushion, they didn't have to rely on high-interest debt, and they were still able to keep investing in the stock market regularly. Maggiulli also warns against a common mistake: hoarding too much cash. Over the long run, markets tend to grow, and those who sit on too much cash end up missing out on the wealth-building potential of stocks, index funds, or real estate. Take another example: Patrick O'Shaughnessy, investor and CEO of O'Shaughnessy Asset Management, explained that he always keeps enough cash to stay flexible, but the majority of his wealth is invested for the long term. When the market dropped sharply in 2020, he stayed disciplined, kept buying at lower prices, and his portfolio recovered quickly as the market bounced back. Key takeaway: smart cash management means holding just enough for safety, but not so much that you miss out on long-term growth opportunities. Striking that balance is one of the key principles for building sustainable wealth over time. Part 4. Housing, Debt, and Major Life Decisions. Nick Maggiulli emphasizes that the big decisions in life, buying a house, taking on debt, or investing in large assets, need to be made carefully because they have long-term effects on your cash flow and investing ability. Many Americans fall into the trap of treating their home as their only investment, often borrowing too much. But the truth is, buying a house isn't always the best path to building wealth. Here's a great example. Grant Sabatier, author of Financial Freedom, shared that after graduating college, he chose to rent instead of buying right away. That decision allowed him to save and invest more in index funds and other income-producing assets. Within just 5 years, he reached financial independence, much earlier than many of his peers who were tied down with large mortgages. When it comes to debt, Maggiulli makes it clear that debt isn't always bad if managed wisely. Borrowing to invest in education, start a business, or buy a reasonably priced home can generate returns far greater than the interest you pay. Take Barbara Corcoran, the well-known real estate investor from Shark Tank. She started her business with a small loan and turned it into a real estate empire worth hundreds of millions of dollars.
By using debt strategically, she transformed risk into opportunity. But Maggiulli issues a warning. Excessive borrowing to chase a high-end lifestyle can choke your cash flow and make long-term investing nearly impossible. For example, many young American families stretch themselves thin by buying luxury cars or homes beyond their means, which leads to financial stress and lost opportunities for wealth building. Key takeaway: think carefully about major financial decisions, manage debt strategically, and focus your resources on things that create lasting value. These choices directly impact your ability to apply the just keep buying principle and build sustainable wealth over time.
Part 5. When to spend and when to save. Nick Maggiulli reminds us that money isn't just for accumulating, it's also for living a better life today. A common mistake people make is delaying happiness, focusing only on saving and investing for the future while forgetting that the present matters too. The principle here is balance, knowing when to spend to enhance your experiences and when to hold on to money for long-term growth. Here's a real example. Chris Hogan, author of Retire Inspired, told the story of a young family in Texas who chose to set aside a small part of their monthly income for family experiences, traveling, extracurricular classes for their kids, or simply dining out together. These expenses didn't break their budget, but they did strengthen their financial discipline while creating memories and joy, things money can't buy if it just sits in an account. Another example, Jenna, a startup founder in San Francisco, instead of saving all of her first profits, set aside a small portion to attend an international conference and connect with investors. That seemingly minor expense opened doors to partnerships and business growth, showing that smart spending can deliver a double benefit, enriching life experiences while also creating financial opportunities. Maggiulli stresses that money should be used wisely, not wasted, but also not left idle for too long. People who find the right balance between spending and saving get the best of both worlds, enjoying the present and building for the future. Key takeaway: spend money to improve your quality of life, but always maintain balance so you don't miss out on long-term investment opportunities. When you know when to hold and when to spend, you'll experience true financial freedom and enjoy life more fully. Part 6. Your financial future. Nick Maggiulli emphasizes that lasting wealth doesn't come from lucky breaks or high-risk bets. It comes from discipline, patience, and a long-term strategy. The core principle of just keep buying is simple: invest consistently, hold for the long run, and let time do the heavy lifting for you. This is the path to wealth that most people overlook. A powerful example comes from Jack Bogle, founder of Vanguard and creator of the very first index fund. He consistently preached that long-term investing, staying patient, and avoiding the temptation to time the market is the true road to success. Those who followed his advice for decades, steadily buying into something like an S&P 500 index fund, have achieved sustainable wealth. Here's a more relatable story. Emily, a teacher in Boston, set aside $100 every week into an index fund right after graduating. She didn't chase hot stocks, and she didn't sell when the market dipped. She simply stayed disciplined for 10 straight years. The result? That modest habit grew into enough wealth for a down payment on a home and a college fund for her kids. This shows clearly that time and discipline, not luck, are the strongest allies of money. Maggiulli also warns that many people get swept up in hot investment trends, from crypto to NFTs to flashy startups, forgetting that most of these come with extreme risk and little long-term stability. By contrast, sticking with a steady, diversified, long-term strategy helps you ride out market shocks and harness the true power of compounding. Key takeaway: sustainable wealth doesn't require outsmarting the market. It requires patience, discipline, and a clear strategy. If you start today, keep buying consistently, and don't panic when the market swings, you'll build a rock-solid financial foundation for your future. Life and money are not a game of chance. They're a journey of patience, discipline, and the small choices you make every day.
Nick Maggiulli reminds us that you don't need to be a genius investor or predict the market with perfect accuracy. What truly matters is investing consistently, saving wisely, and letting time do the rest. Always remember, money is a tool, not the ultimate goal. Knowing when to spend to enjoy life and when to save and invest for the long term will allow you to build both wealth and true freedom. Those small, consistent investments over time can grow into a strong financial foundation, enough to live comfortably, care for your family, and enjoy life without regrets.
On Wall Street, there are two kinds of investors. The first type, smart, fast, always reading the latest news and jumping into every hot stock they can find. The second type rarely talks about money. He simply invests a fixed amount in an index fund every month and forgets about it. 20 years later, something surprising happens. The second guy ends up wealthier, not because he knew more, but because he knew less and did it better. John Bogle, the founder of Vanguard, once said, "Investing is not a game of intelligence, it's a test of character." And millions of people who follow his philosophy, known as Bogleheads, have proven one thing: you don't have to beat the market. You just have to make sure the market doesn't beat you. And in today's video, we'll explore 7 simple, effective, and timeless investing principles from the Bogleheads Guide to Investing. Principles that can help you sleep better, invest smarter, and most importantly, live freer. If you've ever felt that investing is too complicated or that you're not smart enough to become wealthy, this video might change that belief forever. Part 1. The Bogleheads Philosophy. Wealth doesn't require intelligence, just consistency. There's a paradox in the world of finance. The smartest people often make the worst investors. Not because they lack knowledge, but because they think they know too much. John Bogle, the father of the index fund, once said he had met countless people with MBAs working on Wall Street, able to read a balance sheet like it's the morning paper. But when the market turned red, they panicked. And when stocks surged, they rushed in like moths to a flame. Meanwhile, ordinary people, teachers, engineers, nurses, who never read financial news every morning, just quietly invested in index funds month after month, patiently waiting through the ups and downs, ended up becoming the truly wealthy ones. The Bogleheads philosophy was born from that kind of humility. They believe no one can predict the future of the market, so the best strategy is simply not to try. Instead of chasing hot stocks, they choose to own the entire market through index funds. Instead of trying to beat others, they focus on not beating themselves by avoiding mistakes, keeping costs low, and staying invested for the long run. What makes this philosophy powerful is not its complexity, but its elegant simplicity. True wealth doesn't come from being smarter than others, but from staying consistent with your principles when everyone else loses faith. As the great investor Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." The Bogleheads are living proof of that. They're not trying to win every battle. They're focused on winning the only war that truly matters, the war against their own emotions and impulses.
Part 2. Living below your means, the root of all wealth. If you ask any successful investor, what's the biggest secret to building wealth? They won't talk about technical analysis or about finding the next stock that goes up tenfold. They'll tell you something that sounds almost too simple. Spend less than you earn and invest the rest. It sounds easy, but in reality, it's one of life's greatest challenges. In America, one of the wealthiest nations on earth, most people still live paycheck to paycheck, even though incomes are higher than ever before. Not because they're lazy, but because they're caught in a race with no finish line. The upgrade life race. Upgrade the house, upgrade the car, upgrade the phone. Meanwhile, the savings account stays exactly the same. John Bogle once said, You can't buy freedom with things you don't need. It sounds like moral advice, but it's actually a financial strategy. Because if you want to invest, you first need money to invest. Take the story of Sarah, a high school teacher from Ohio. She doesn't make much, about $55,000 a year. But she follows one simple rule. Live on 70% of her income, save 10%, and invest 20% in index funds. For 25 years, she didn't buy a new car, didn't rack up credit card debt, just kept investing month after month. By age 55, Sarah had over $1.1 million in her investment account. And something even more valuable, she never worried about money. Meanwhile, there are people earning $200,000 a year who still feel suffocated by credit card debt. Because every time their income goes up, their lifestyle expands with it. Bigger houses, newer cars, and well-deserved luxury vacations. That's not financial freedom. That's financial slavery, wrapped in glamour. Bogleheads understand this deeply. They don't live in extreme frugality, they simply spend intentionally. They know the difference between wants and needs, and they understand that every dollar not spent today is a brick laid for tomorrow's freedom. As Bogleheads like to say, your true wealth isn't measured by the things you own, but how long you can live without needing a paycheck. Living below your means isn't about deprivation. It's about selective living, choosing what truly adds value and cutting out what doesn't. Just like pruning a tree helps it grow taller, cutting unnecessary expenses allows your wealth to grow stronger over time. Part 3. The power of compound interest. Time is your most valuable asset. Albert Einstein once said, "Compound interest is the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it." That quote sounds simple, but behind it lies the key to all lasting wealth. In the world of the Bogleheads, no one tries to predict the market. No one tries to beat Wall Street. All they need is time and consistency. Because when you invest early, time starts to work its quiet magic, turning small numbers into big ones and discipline into freedom. Imagine two friends the same age, Tom and David. Tom starts investing $5,000 a year at age 25 and stops after just 10 years, a total of $50,000. David decides to wait until he's ready. He starts at 35 and invests $5,000 every year until he's 65, a total of $150,000. When both retire at 65, who has more money? Not David, even though he invested 3 times as much. It's Tom, because time worked for Tom, turning his first 10 years into 40 years of compounding growth. Tom ends up with nearly $950,000, while David finishes with just over $800,000, despite investing $100,000 more. That's the silent power of compound interest. It rewards those who start early and punishes those who wait. Many Americans still believe they need a lot of money to invest, but Bogleheads think differently. They know it's not about how much you have, it's about when you start. A small investment today is far more powerful than a big investment 10 years from now. Warren Buffett is living proof of that. He began investing at age 11, and over 90% of his wealth came after he turned 65. Not because he was smarter, but because he was more patient. He understood that the stock market is a device for transferring money from the impatient to the patient. In the Bogleheads Guide to Investing,
Taylor Larimore reminds us, "Let time be your ally, and the market will do the rest." No complicated strategy, no market timing, just a simple index fund, regular contributions, and the patience to let compounding work uninterrupted. Remember, time doesn't just grow your money, it protects you from mistakes. As the years pass, short-term noise fades away, and what remains is growth in the economy, in your portfolio, and in yourself. Because investing isn't about getting rich fast. It's about letting your money work long enough so that you don't have to work forever.
Part 4. Investing Made Simple. The Power of Index Funds. If there's one idea that defines the entire Bogleheads philosophy, it's this: investing doesn't have to be complicated to be effective. For decades, the financial industry has tried to make investing look like rocket science. They throw around fancy terms: alpha, beta, arbitrage, momentum. They convince you that only the experts, armed with supercomputers and PhDs, can beat the market. Then came John C. Bogle, the founder of Vanguard, who said something that shook Wall Street to its core. Don't try to beat the market, just own it. He created the world's first index fund, an idea mocked at the time as a fund for idiots. But Bogle didn't care. He understood that instead of trying to pick the winners, owning the entire market was a far more reliable way to win. Why? Because most professional investors, hedge funds, mutual funds, and analysts alike, underperform the market over time. Not because they're bad at their jobs, but because fees and taxes slowly eat away their returns. An index fund, on the other hand, doesn't try to outsmart the market. It simply tracks it with ultra-low costs, no emotion, and total automation. That means you don't need to guess which stock will rise next. You don't need to worry about breaking news or CNBC hot tips. You just invest regularly and let time do the work. Here's the math. According to S&P Dow Jones indexes, over 90% of actively managed funds in the US underperform the S&P 500 over 15 years. Meanwhile, an ordinary investor who simply bought an S&P 500 index fund, sat still, and did nothing, outperformed almost the entire Wall Street machine. Bogleheads call this the art of simplicity. They understand that every time you try to outsmart the market, you're stepping into a game you cannot win. But every time you keep things simple, invest in low-cost index funds, contribute regularly, rebalance once a year, you're playing a game you can't lose. Think about it. If you invest $1,000 a month in an S&P 500 index fund, earning an average of 8% a year, you'd have nearly $1.5 million after 30 years. No stock picking, no timing the market, just consistency. That's what made John Bogle the quiet hero of millions of American investors. He never promised you'd get rich quickly. He simply showed you how to get rich surely. As Bogle himself once said, the market may fluctuate, but low costs and long-term discipline never betray you. Bogleheads believe that financial freedom doesn't come from knowing more, but from wanting less. Less noise, less worry, less ego about being smarter than the market. Because in the end, simplicity always wins in a complex world. Part 5. Diversification. Don't put all your eggs in one basket. One morning in 2008, America woke up in panic. The biggest banks were collapsing like dominoes. Lehman Brothers went bankrupt, AIG needed a bailout, and within weeks, millions of people lost their life savings. But here's the thing. Many of them didn't lose because they invested wrong. They lost because they put everything in one basket. One person poured all their money into their company's stock, believing,
I know this business better than anyone. Another went all in on real estate, thinking land never loses value. Someone else bet everything on crypto because this is the future. Then a single unexpected storm hit and everything vanished. That's why Bogleheads don't see diversification as a tip, they see it as a survival rule. John C. Bogle once said, "Don't seek perfection in every investment, seek safety in the whole portfolio." So what does diversification really mean? It's not just about spreading money around, it's about spreading risk. A smart Boglehead-style portfolio might include stocks, index funds for long-term growth, bonds, bond funds for stability, cash or money market funds for flexibility when needed. The exact mix depends on your age, goals, and risk tolerance, but the core idea stays the same. Never let one bad event cost you your peace of mind. Here's a very American example. During the 2020 COVID crash, the US stock market fell over 30% in just a few weeks. But investors who held a mix of S&P 500 plus government bonds plus cash funds only saw losses around 10 to 12%, and most recovered within months. Meanwhile, those who went all in on tech stocks lost 50 to 70% of their portfolios and spent years trying to recover. Bogleheads believe diversification is free, but the lack of it can cost you a lifetime. Because no one knows which sector will win in the next 5 years, tech, energy, or bonds. But one thing's for sure, if you spread your bets wisely, you'll never lose big. And that's something more Americans are learning today. Diversification won't make you rich overnight, but it will make sure you never go back to zero. You don't have to be right all the time. You just have to avoid being completely wrong even once. Because in the end, the goal of investing isn't to be a genius, it's to be the one who stays in the game the longest.
Part 6. Don't try to time the market. If there's one illusion that has cost Americans more money than anything else, it's the belief that they can predict the future. When the market goes up, everyone thinks they're a genius. When it goes down, everyone says, "I'll just wait a little longer." But that little longer often turns into months or years, and the real opportunity is already gone. John Bogle, the founder of Vanguard, once said, "No one knows when to get in or out of the market, and if someone says they do, they're lying." That's not pessimism, it's humility from a man who spent his entire life watching markets and realized that no one can outsmart randomness. Think back to 2020, when COVID-19 hit. The US market dropped more than 30% in just a few weeks. People panicked and sold, believing this time everything will collapse. But just 6 months later, the S&P 500 hit new all-time highs, and those who simply stayed put were the ones who won. Meanwhile, millions of investors tried to jump in and out, buying on good news, selling on fear, and ended up doing worse than those who did nothing at all. A Morningstar study showed this clearly. Over the past 20 years, the US market returned about 8% per year, but the average individual investor earned only around 4%. Why? Because they timed the market and got it wrong. Bogleheads don't try to predict the future. They just stay patient, automated, and disciplined. They know the market is like the tide. It rises and falls, but you only drown if you panic and swim against it. Here's a familiar example from many Americans. During the dot-com crash of 2000, those who held on to their S&P 500 index fund for the next decade still earned roughly 6 to 7% per year. But those who got out to wait for a better time usually bought back in after the recovery, missing the strongest part of the rebound. John Bogle called this the tyranny of timing. You get obsessed with doing something right now when the smartest move
is often doing nothing at all. As Bogle said, stay the course. Stay on your path, no matter what the market does. That's why Bogleheads don't treat investing like a game. They see it as a lifelong journey. You don't need to win every quarter or every year. You just need to let time do its work. Because in the end, consistency beats intelligence, and calm beats urgency. Remember this, the market will always move up and down. But if you have a plan, discipline, and faith in time, you'll never need to predict anything at all. Part 7, Psychology and Discipline. Your biggest enemy is yourself. In investing, intelligence is common, but patience is rare. If you've ever opened your stock app in the morning, felt your heart race when the numbers were green, and sunk when they turned red a few hours later, you've experienced what every investor, no matter how smart, goes through: emotional investing. John Bogle, the father of index funds, saw millions of Americans lose money not because they made bad investments, but because they couldn't handle fear. When the market drops 10%, they think, I need to get out now. When it rises 20%, they think, I'm missing out. And so they keep buying high and selling low, again and again. A Dalbar study found that over 30 years, the average investor earned only 3 to 4% per year, while the S&P 500 returned over 10%, not because investors picked the wrong stocks, but because they couldn't control themselves. Bogleheads know this well. They don't let emotions steer the ship. They let principles do it. They have a plan, and they stick to it, even when the market tests their patience. Think of it like climbing a mountain. When the fog rolls in and you can't see the summit, the impatient turn back. The disciplined keep walking. Investing is the same. The market doesn't reward the fastest reactors, it rewards the calmest believers. Here's a familiar American example. During the 2008 financial crisis, millions cashed out their 401ks in panic. But those who kept contributing monthly and held steady in low-cost index funds, by 2018, their portfolios had doubled or even tripled in value. Not because they were smarter, but because they had better self-control. Bogleheads don't try to beat the market. They try to beat themselves every single day. They know investing isn't a test of IQ, it's a test of EQ, emotional intelligence. As Taylor Larimore, co-author of the Bogleheads Guide to Investing, said, keep a cool head and a warm heart, because in the end, the market is nothing more than a mirror reflecting human emotion. If you can stay calm through the storm, you're already ahead of 90% of investors out there. Financial freedom isn't a dream reserved for the special few. It's the result of small habits repeated consistently over time. Spending less than you earn, investing regularly, and trusting in the quiet power of compound interest. You don't need an IQ of 150. You don't need to predict the market. You just need a simple plan and the discipline to stick to it, no matter how chaotic the world becomes. That's the spirit of the Bogleheads, where patience beats speed and simplicity outsmarts complexity.
On Wall Street, everyone believes the secret to getting rich is simple. Buy low, sell high. Outrun the crowd or get inside information a few seconds before everyone else. But there was one man, among all that noise, who chose a different path. He didn't care about short-term price swings. He wasn't tempted by the hot stocks on financial headlines, and he almost never rushed to hit the sell button. His name was Philip Fisher, and his investing philosophy completely changed the way Warren Buffett saw the world. Fisher didn't believe investing was a game of intelligence. He believed it was a game of understanding. He once said, "Don't buy a stock,
buy a part of a business you want to own forever. And strangely enough, while everyone else was chasing prices, Fisher was chasing meaning, value, and the people behind each company. With that mindset, he turned the idea of common stocks into uncommon profits. If you've ever felt lost among thousands of ticker symbols, lost sleep over market ups and downs, or asked yourself, is there a more sustainable way to invest? Then this video is for you. Because right now, we're about to explore 6 timeless lessons from Common Stocks and Uncommon Profits, the book that helped an entire generation of American investors stop guessing the market and start understanding it. Part 1. Philip Fisher's philosophy: quality over cheapness. When Philip Fisher was young, people often asked him, "How do you find such high return stocks?" He would simply smile and say, "Because I don't look for stocks, I look for great businesses." If you notice, most investors today are still obsessed with prices. We open our apps, watch the red and green charts, and within seconds, our mood rises and falls with those numbers. We tell ourselves, this price is so cheap, it must be a good buy. But Fisher would say, the bargain you see today might be the trap you fall into tomorrow. He was born in an era when the market believed investing was all about bargaining. Buy low, sell high. But Fisher realized something deeper. Truly great businesses aren't priced on a stock ticker. They're measured by how fast they change the world. Instead of hunting for cheap stocks, Fisher searched for companies led by people who thought beyond the next quarter. Leaders who reinvested profits, built cultures of innovation, and put customers before shareholders. He loved visiting factories, talking with engineers, and meeting frontline employees, the people who truly understood the company. To him, investing wasn't about reading financial reports. It was about reading people. One classic story: when most investors ignored Motorola because its stock looked too expensive, Fisher saw something else. He saw not just a radio manufacturer, but a gateway to the coming era of mobile communication. So he invested heavily. The result? Motorola became one of his legendary investments, multiplying in value many times over the years. Fisher believed that the stock of a great company is never truly expensive if you're patient enough. That wasn't blind optimism. It was conviction rooted in genuine growth and quality. A great company, he said, is like an oak tree. It grows slowly, but its roots run deep. A cheap company, on the other hand, is like a weed. It grows fast, but dies quickly. He once wrote, "A mediocre company, no matter how cheap you buy it, will only give you mediocre results. But an outstanding company, even at a high price, will bring you extraordinary returns over time." The market will always fluctuate. News headlines will always make you doubt your choices. But Fisher believed that real wealth comes from patience and deep understanding. He didn't invest in numbers. He invested in belief. The belief that a company will get better year after year. And that's what most of us forget. Investing isn't about racing the market. It's about choosing the right path and staying on it long enough. Today, when Warren Buffett says, "I'm 85% Graham, 15% Fisher," he's acknowledging that it was Fisher who helped him realize this truth. The real value doesn't lie in how cheaply you buy, but in finding something truly worth holding on to. Fisher's lesson is simple, yet sharp. Don't look for cheap stocks. Look for companies that are becoming greater every day. Because in the long run, quality always beats cheapness.
Part 2. The Scuttlebutt Method. Learning about a company beyond the balance sheet. Most investors believe that truth lives in the numbers: revenue, profit margins, EPS, PE ratios, free cash flow, all neatly listed in hundreds of pages of annual reports. And they think that reading them all is enough to understand a business. But Philip Fisher didn't believe that. To him, a company was a living organism, and numbers were just its vital signs, not its soul. If you want to know how healthy a company really is, you have to step outside the office, step away from your screen, and listen to what people are saying about it. That's what Fisher called the scuttlebutt method, one of the most original ideas he ever gave to the investing world. The word scuttlebutt originally came from the Navy. It meant the place where sailors gathered to gossip and share rumors. Fisher borrowed that term to describe a way of collecting real-world information, talking to employees, customers, suppliers, even competitors. He believed that, quote, "What people say about a company is often more truthful than anything the company says about itself," unquote. Imagine you're researching a tech company. Its financials look perfect, revenue rising, profits steady, debt low. But then you talk to a few engineers who work there, and they tell you, quote, "We're losing our best people every month." Then you talk to a customer, and they say, quote, "Their service has gotten really slow lately," unquote. Those small comments might seem trivial, but they're early warning signs of decline, the kind that numbers haven't yet revealed. Fisher would spend weeks doing this kind of investigation. He'd ask employees if they were proud to work there. He'd ask suppliers whether the company paid on time. He'd ask customers if they truly trusted the product. And most importantly, he would listen. Listen to how people spoke about the company when no one asked them to say something nice. Once, he avoided a major investment after hearing a low-level employee say that management only cared about the stock price, not the product. A few years later, that company collapsed under internal scandals. Scuttlebutt had saved him a fortune. This method might sound old-fashioned, but in today's world, where everyone invests from behind a screen, it's more valuable than ever. You can read 10 reports or 20 analyst notes, but you'll never truly understand a company until you talk to real people with real experiences. Scuttlebutt teaches us a lesson that goes far beyond investing. Don't just trust data, trust human experience, because in the end, it's people who create or destroy a company's value. Fisher once said, "Investing isn't just the art of analysis, it's the art of listening. Listening to what the market hasn't said yet," unquote. And that's what made him different. While most investors stared at their screens, Fisher listened to the real world, and that's how he saw opportunities everyone else missed. The lesson? To understand a company, don't just read its reports. Read the people behind them, because that's where truth and profit truly hide.
Part 3. The 15 points of a great company. When Philip Fisher was once asked, "How do you know if a company is worth investing in for the long run?" he simply smiled and said, "I don't have a crystal ball, but I do have 15 questions." Not a magic formula, but a mental map to help investors find extraordinary companies amid the noise and chaos of the market. 1. Does the product or service have long-term growth potential? Fisher always started with vision, not revenue. He believed great companies don't just sell what's hot, they create what's next. Think about it. Apple didn't just make phones, it redefined how people communicate. Amazon didn't just sell goods, it reinvented how the world shops. If a company only sells what works today, it disappears when the trend fades. But if it builds what the world needs tomorrow, it endures. 2. Is management capable and visionary? A company can never grow beyond the limits of its leaders. Fisher spent time observing how CEOs made decisions. Were they willing to sacrifice short-term profits for long-term strength? Did they keep their promises to employees and investors? He once said, "A good management makes me want to invest. A bad one makes me want to run." 3. Innovation and R&D. Fisher saw innovation as the backbone of growth.
He distrusted companies that live off their legacy, relying on old products while creating nothing new. If a company doesn't invest in its future, no matter how profitable it looks today, it's just a dying past in disguise. 4. Are the profit margins stable and expanding over time? Fisher called this the sign of an invisible moat, the true ability to defend value. Short-term fluctuations happen, but if margins remain strong year after year, it's proof of real strength, brand, systems, or culture. 5. Does the company control its costs well? A great company spends wisely. As Warren Buffett said, "You don't have to be smarter than others to get rich. You just have to be more disciplined." Fisher looked for companies that practiced rational spending, investing where it mattered, cutting where it didn't, and never let greed cloud judgment. 6. Does it have a durable competitive advantage, a moat? Not every company needs a monopoly, but it must have something others can't easily copy. It could be brand, technology, data, or a loyal community. Fisher said, "If you can replace a company with its competitor in one day, it's not worth investing in." 7. How does it treat its employees? Fisher believed, how a company treats its employees will reflect how it will treat its shareholders. A company that encourages creativity and respects its people builds the inner drive to go farther. He often asked employees, "Are you proud to work here?" If the answer was no, he moved on. 8. How does it treat its customers and suppliers? A company might be great at selling, but if it's hated by customers or bullies its suppliers, it won't last. Fisher looked for mutual respect because that's the foundation of lasting growth. 9. Debt management. He warned that debt isn't evil. Debt is only good if you can sleep well with it. Companies that borrow for short-term gain will always live in anxiety. 10. Does the company think long-term? Fisher admired businesses that weren't afraid to plan for the next 10 to 20 years. He once invested in a company after hearing its CEO say, "We're not trying to make the most money this year. We're trying to make money forever." 11. Is the company culture honest and transparent? No number is beautiful enough to hide dishonesty. For Fisher, integrity was non-negotiable. If management hid small things, they'd hid bigger ones when the stakes rose. 12. Can the company adapt to change? The world changes fast. Fisher believed good companies defend, great companies adapt. He looked for businesses willing to evolve their models, products, or strategy without losing their soul. 13. Dividend policy and reinvestment. A smart company doesn't just know how to distribute cash, it knows when to keep it. Fisher disliked large dividends if the company still had strong growth opportunities. He knew that $1 reinvested wisely could become 10 in the future. 14. The relationship between growth and profitability. Growth is good, but only if it's quality growth. If revenue rises through discounts, debt, or massive marketing spend, Fisher saw that as a red flag. He looked for growth born from great products and loyal customers. 15. Can the business scale? Fisher always asked, if revenue doubles, will costs double too? A great company grows efficiently. Its profits expand faster than its expenses. That's the mark of a powerful business model and the dream of every long-term investor. When Fisher finished his 15 questions, he wasn't just choosing a stock. He was choosing a partner, a business he could live with for decades. He once said, "A good stock isn't for trading, it's for marrying." Those 15 points were his pre-marriage checklist for every investment. If a company couldn't pass, he'd simply smile, walk away, and wait for the right one. The lesson? Investing isn't about guessing prices. It's about finding companies you can trust and growing together over time. Fisher's 15 points are the compass that guides you on that journey.
Part 4. The art of holding, when patience becomes a competitive advantage. There's a strange paradox in investing. Everyone talks about long-term investing, but very few people actually stay long enough with their own investments. Because the market doesn't just test your wallet, it tests your heart, nerves, and faith every single day. Philip Fisher once told a story about a friend who invested during his time. That friend bought shares of Texas Instruments very early on, just a few years after the company began commercializing the world's first silicon transistor. At first, the stock doubled, then tripled. The investors sold everything and celebrated his big win. But a few years later, Texas Instruments became one of the great technology icons of the 20th century. Its stock had risen more than 40-fold. Fisher quietly said, "He won, but he lost to time." To Fisher, time was the greatest competitive edge most investors never developed. He believed a great stock doesn't need to be bought many times. It only needs to be held long enough. Holding, not out of stubbornness, but out of understanding. Fisher was not blindly devoted to the buy and hold mantra. He didn't hold stocks because he was lazy to sell. He held them because he deeply understood the businesses behind them. He said, if you don't know why you own a stock, you'll panic the first day it goes down. Owning shares of a great company, Fisher said, is like owning a fertile piece of land. You don't need to plow it every week. You just need to give it time to work. But that kind of patience must be built on understanding, not blind faith. The market feeds on news. Real investors feed on patience. Fisher often smiled watching Wall Street panic over daily headlines. He said, news is the food of speculation, but value is the food of investment. When markets turned red, he didn't look at charts. He looked at companies. Are they still innovating? Do customers still love their products? Does management still think long-term? If the answers were yes, then falling prices were opportunities, not threats. Patience, the most underrated financial skill. Fisher believed investors didn't need to be smarter than the crowd, just more patient. He often said, the market is a device for transferring money from the impatient to the patient. Patience, however, is not mere waiting, it's waiting the right way. Waiting with confidence, not anxiety. Warren Buffett later echoed this idea in his own words. If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Time, the true ally of great businesses. The companies Fisher admired most, like Motorola, Texas Instruments, or Dow Chemical, all shared one thing in common. They needed time to become great. No company can prove its worth in a single quarter, just like no oak tree grows tall in a single spring. Fisher said, when you own shares of a truly outstanding business, time works for you, not the market. Fisher's lesson, know when to do nothing. In a world obsessed with new strategies, Fisher chose the simplest one of all, patience. He understood that constant action doesn't equal progress. The market rewards those who wait, not those who predict. When asked, what's the secret to successful investing? He simply said, let time do the hardest work. In the end, Fisher taught that real wealth doesn't come from buying at the right time, but from holding in the right place. Not from seeing farther than others, but from waiting long enough for that vision to come true. Final lesson. In investing, patience is not passivity. It's the highest form of action, where time, value, and conviction quietly work in your favor.
Part 5. When to sell a stock. Knowing when moving on is actually moving forward. There's an old saying on Wall Street. no one ever went broke taking a profit. But Philip Fisher didn't quite agree. He once smiled and replied, "True, but plenty of people got poorer by selling too soon." The biggest mistake isn't buying wrong, it's selling wrong. Fisher often said that most of the greatest fortunes he'd ever witnessed didn't come from picking the right stock, but from holding the right company and refusing to sell when everyone else did. He told the story of his investment in Motorola back when it was just a small radio manufacturer experimenting with transistors. Many investors rushed to sell after the stock rose 50%, saying, "That's enough profit for me." But Fisher didn't sell. He said, "I sell only when the reason I bought no longer exists." Motorola went on to become a global technology powerhouse, returning many times his original investment. The only 3 real reasons to sell, and nothing else. Fisher was extremely disciplined when it came to selling. He believed investors should sell a stock for only 3 legitimate reasons. 1. When you were wrong from the start. If the assumptions that led you to buy turn out to be false, say management proves incompetent, or the company's competitive edge turns out to be temporary, then sell immediately, even at a loss. Fisher called this the market's tuition fee. 2. When the business stops being itself. If the company starts losing its core DNA, stops innovating, expands recklessly, or leadership becomes obsessed with short-term profits, it's time to step aside. Fisher once sold a leading chemical stock simply because the new CEO had started chasing prestige instead of technical progress. He said, "A company can't stay great if it's no longer humble enough to keep learning." 3. When a clearly superior opportunity appears. Not another opportunity, a better one. That means finding a company with stronger leadership, a longer-term vision, and growth prospects far exceeding what you currently hold. In that case, selling isn't giving up, it's reallocating your capital to a brighter future. Don't sell out of fear. The market will always test your nerves. Fisher understood that the market is a master manipulator of emotions. Prices will fall, headlines will scream, and people will shout, "Sell before it's too late." But he believed it's not the market that makes us poor. It's fear that makes us act foolishly. Selling just because the price drops is an instinct, but usually the wrong one. If your reasons for buying are still valid, the company is still growing, its product still strong, its leadership still steady, then don't let the daily ticker shake your conviction. Because Fisher knew that a company's growth curve is never a straight line. It dips, twists, and turns. And in those dips, the patient investors are the ones most richly rewarded. When not to sell? When reason wins over emotion. Fisher warned that investors often sabotage themselves by being too clever. They sell to lock in profits and buy back cheaper. But the truth is, no one consistently predicts bottoms. He once said, if you sell only because you think you can buy it back cheaper, you're no longer investing, you're gambling. Many people try to sell at the peak and end up missing entire decades of growth. Fisher chose the simpler path, to trust in great companies and let time do the hardest work. Selling isn't just an action, it's a test of character. Fisher viewed selling as a moment of honesty. Are you acting out of logic or emotion? He said, if you sell out of fear, you're running away. But if you sell because your vision is changed, you're moving forward. That distinction separates a mature investor from someone merely chasing the thrill of winning and losing. In the end, knowing when to walk away is also wisdom. Fisher believed that the art of investing lies not only in choosing well, but also in knowing when to let go. Not because you're tired, but because you're clear-eyed enough to see that value has moved elsewhere. Sell when the reasons you once believed in no longer hold true. Don't sell just because the world around you has lost its calm. Final lesson. Selling isn't the end of an investment journey. It's the beginning of awareness, where you learn that maturity sometimes means having the strength to stand up and walk away at the right moment.
Part 6. Focused Investing. Know fewer companies, but know them deeply. Warren Buffett once said, "I'm a disciple of Benjamin Graham, but I follow the path of Philip Fisher." And that's where the real difference lies. If Benjamin Graham taught investors how to buy cheap, Philip Fisher taught them how to understand deeply. So deeply that you could talk about a company the same way you talk about your best friend. Fisher didn't believe in diversifying for safety. In a world where every finance book says don't put all your eggs in one basket, Fisher went the other way. Over-diversification is a sign of ignorance. He wasn't against spreading risk, but he believed diversification should come from understanding, not fear. According to Fisher, you don't need 50 or 100 stocks to sleep well at night. You only need 5 to 10 truly exceptional companies, and to know them deeply enough to understand what creates their value and what could destroy it. The story: one basket and the right hands. Fisher once told the story about a young investor who asked them, "If I only invest in a few companies, isn't that too risky?" He smiled and said, "No. Risk doesn't come from having your eggs in one basket. It comes from not knowing who's holding the basket." That was his philosophy. When you understand deeply, you stop fearing volatility. When you understand the essence, daily price swings can't shake your conviction. Focused investing demands commitment of mind, not just money. Fisher would spend months studying a single company. He'd visit factories, talk to engineers, employees, customers, and even competitors. He wanted to know, does the management truly love what they do, or just the profits? Is the company still innovating, or just living off past success? Do employees feel proud to say they work there? For Fisher, investing wasn't about reading financial reports. It was about understanding the soul of a business, the difference between knowing the price and knowing the value. Fisher once said, "Most investors know the price of the stocks they buy. Very few understand the real value of the businesses behind them. Those who only know the price sell when the market panics. Those who understand the value buy more." And it's this depth of understanding that allows focused investors to stay calm amid market noise, because they know they own a piece of a genuine value-creating machine. Focused investing isn't for the impatient. Fisher warned, if you can't stand seeing your stock drop 30% while still believing in the company, you shouldn't call yourself an investor. To focus is to endure loneliness, to trust your own analysis when the crowd is panicking, to hold on when everyone else is selling because you understand something they don't. He believed the market rewards depth, not breadth. A lesson from modern investors. In today's world where people chase diversification, ETFs, and portfolios with hundreds of stocks, Fisher's philosophy may sound old-fashioned, but in truth, it's more relevant than ever. Because now investors can buy thousands of stocks with just a few clicks, and yet the more they diversify, the less they truly understand what they own. Focused investing reminds us, you don't need to know everything to build wealth. You just need to understand a few things deeply. You don't have to run faster than everyone else, you just have to stand firmer when everyone else is afraid. Conclusion. Focus is a virtue, not just a strategy. Fisher taught that investing isn't a game of probabilities, it's a test of patience, depth, and conviction. Know a lot about a few companies rather than a little about them all. Because in that depth, you don't just find profits, you find peace, even in a market that's always in chaos. In the end, Philip Fisher didn't just teach us how to pick stocks. He taught us how to think like true investors, to be patient, to understand deeply, and to believe in long-term value over short-term noise. In a world obsessed with quick profits, he reminded us that lasting wealth only comes to those who have the courage to move slowly but steadily.
Have you ever checked your bank account right after payday and thought, where did all my money go? You work hard, 40 hours a week, but one unexpected medical bill or a $1,000 car repair, and suddenly all your plans fall apart. Even worse, you've been told the solution is to cut out Starbucks or stop eating out. But deep down, it still feels like you're running on a hamster wheel, exhausted but not getting anywhere. The book I Will Teach You to Be Rich by Ramit Sethi doesn't teach you to live miserably or count every penny. Instead, it shows you how to build a smart money system where your money works for you automatically, so you can enjoy life today while still building a wealthy future. If you want to break free from living paycheck to paycheck and finally take control of your financial life, make sure to watch this video until the end. And don't forget to hit like and subscribe so you won't miss out on more powerful money tips. Part 1. Rethinking Wealth. In I Will Teach You to Be Rich, Ramit Sethi begins with a truth many Americans can relate to. We often have a stressful relationship with money. Some people feel their heart race when they check their bank account, feel guilty every time they swipe their card, or simply avoid thinking about personal finance altogether. Ramit argues that wealth isn't just about how much money you have in your account, it's about being able to live the life you truly want. If you define wealth only as having $1 million or owning a big house, you'll always feel like it's never enough. But if you define it as not worrying about money and having the freedom to spend on the things you genuinely love, then you can start living a rich life today. One of Ramit's standout ideas is to stop obsessing over the tiny details and instead focus on what he calls the big wins. You've probably heard the advice: skip your daily Starbucks to save a few hundred or maybe a few $1,000s a year. But Ramit points out that cutting coffee won't change your life. On the other hand, if you automatically invest just $500 a month into a 401k or Roth IRA, in 30 years, you could have nearly $500,000. Or if you pick up the phone and negotiate your credit card interest rate down a few points, you could save thousands in interest every year. And even when buying a car, choosing a 2 to 3-year-old used car instead of the latest model can instantly save you tens of thousands of dollars. This is the core of Ramit's message. Wealth doesn't come from pinching pennies, but from building a smart system that allows you to spend freely on what you love while cutting costs on what doesn't matter. As he puts it in plain terms, buy as many lattes as you want as long as you're also automatically investing in your future. That's the first step to transforming your mindset about money, from one of scarcity to one of conscious freedom. Part 2. The Automatic Money System. Ramit Sethi says most of us don't fail at money because we lack knowledge, we fail because we lack a system. Think about going to the gym. If you wake up every day and ask yourself, should I work out today? Chances are you'll skip it. But if you've already booked sessions with a trainer and paid in advance, you're almost guaranteed to show up. Money works the same way. Success isn't about sheer discipline. It's about creating an automatic system that manages your money for you even while you're asleep. Ramit's approach is simple and practical. Imagine it's the first of the month and your paycheck comes in. Instantly, your system distributes that money automatically. Part goes into your 401k or Roth IRA for retirement, part into an emergency savings account, part toward credit card or loan payments, and the rest flows into your daily spending account. It all happens behind the scenes. You don't have to remember or make a decision each time. By the end of the month, you can spend freely from your checking account without guilt because your saving and investing are already taken care of. The reason so many Americans feel stressed about money is because they're constantly forced to choose. How much should I save? Should I invest? Can I afford this? But once you have an automatic system, those choices are made for you ahead of time. That's why people who adopt Ramit's method often feel like a huge weight has been lifted off their shoulders. They don't sweat the small spending decisions anymore because they know they're on track long-term. Take retirement contributions, for example. If you rely on manually transferring money into your 401k every month, it's easy to miss a month or two when life gets busy, and that lost time could cost you thousands in compound growth.
But if you set it up to pull straight from your paycheck, you never even see the money. And that invisibility is powerful. You can enjoy spending the rest guilt-free, knowing your wealth is quietly growing in the background. In simple terms, an automatic money system turns complex financial decisions into unconscious habits. It's like your money is working a full-time job for you while you get to live your life.
Part 3. Smart Long-Term Investing. Ramit Sethi emphasizes that investing isn't gambling, and it's not a race to pick the next hot stock you see on CNBC. Smart investing, he says, is about choosing the long-term, simple, and consistent path. Instead of spending hours researching the market or stressing over every price swing, all you really need to do is stick to a handful of proven principles. And the most important one Ramit repeats again and again is time in the market matters more than timing the market. He points out that most professional investment funds, with teams of analysts and huge resources, still fail to beat the S&P 500 over the long run. That means instead of trying to outsmart the market, everyday investors should follow a simple strategy: put money into low-cost index funds and benefit from the growth of the entire economy. That's why Ramit recommends most people choose something like the Vanguard Total Stock Market Index Fund or an S&P 500 Index Fund, because they're low-cost, diversified, and have delivered steady returns for decades. Here's an example. If you invested just $500 a month into the S&P 500 starting at age 25 and kept going until 65, you could end up with over $1 million, thanks to the power of compound interest. Meanwhile, while many Americans waste hours obsessing over short-term trades and panicking during downturns, those who stick with this simple long-term approach quietly win. The reality is, countless Americans get caught up in the temptations of day trading or financial fads like GameStop or crypto hype. They chase the thrill when the market goes up and feel the pain when it crashes. Ramit calls this the casino mindset. You might win big once, but eventually you lose. On the other hand, those who patiently invest in index funds, reinvest dividends, and ignore short-term noise are the ones who cross the finish line with lasting wealth. Put simply, Ramit's idea of smart investing isn't about striking gold. It's about planting seeds and letting time grow them. Your financial future doesn't depend on predicting the market. It depends on whether you're disciplined enough to stay invested for 10, 20, or even 30 years. Part 4. Spend on what you love, cut what you don't. Ramit Sethi's financial philosophy is very different from the usual harsh advice you hear about cutting back and living frugally. He doesn't tell you to pinch every penny, deny yourself small pleasures, or obsess over spreadsheets. Instead, he introduces the idea of conscious spending, deciding where your money goes with intention, instead of letting it slip away without noticing. In Ramit's view, a conscious spending plan isn't about tracking endless rows of numbers. It's about making clear choices. Spend extravagantly on the things that truly bring you joy, value, and meaning, and ruthlessly cut out the things you don't care about. For example, if travel excites you, go ahead and splurge on unforgettable trips, even business class flights. But if driving a brand new car or eating out every night doesn't matter to you, then cut those expenses entirely, without guilt. Many Americans get trapped in the cycle of keeping up with the Joneses, spending to keep pace with neighbors, friends, or social pressure. Someone buys a big house, so you feel you need one too. Someone drives a Tesla, so you think you should as well. Someone posts photos from an upscale restaurant, and you feel you have to match it just to not fall behind. But in reality, these expenses don't reflect your true values. They're consumer traps that pull you further away from financial freedom. Picture a young American couple with solid incomes. Instead of piling on debt to upgrade their car every 3 years, they decide to drive their old Toyota a few more years. With the money they save, they choose to fund trips around the world, experiences and memories that last a lifetime. That's the essence of Ramit's message. Spend lavishly on what you love and mercilessly cut what you don't. The core idea is this: wealth isn't about how much money sits in your account. It's about using money to live the life you truly want. Once you're clear on what matters most to you,
spending becomes empowering instead of stressful. And for Ramit, that's the real path to lasting happiness and financial freedom.
Part 5. Negotiating and increasing your income. In I Will Teach You to Be Rich, Ramit Sethi highlights a truth many people overlook. You can't just save your way to wealth. Cutting back on a few Starbucks lattes might save you a couple $100s a year, but increasing your income is the real lever. He calls these big wins, decisions or skills that can earn you tens of thousands of dollars over your lifetime, not just a few bucks each week. One of the most powerful big wins is negotiation. Many Americans shy away from negotiating because they fear rejection or think it will make them seem difficult. But Ramit shows that just one successful salary negotiation could add $5,000 to $10,000 a year to your income. And it doesn't stop there, because a higher starting salary compounds over time. Every future raise and bonus is based on that higher number. It's compound interest applied to your career. For example, imagine you're offered a tech job in San Francisco at $90,000 a year. If you accept without negotiating, you're locked into that number. But if you negotiate skillfully, backing it up with clear examples of your achievements and the value you bring, you might raise the offer to $100,000. That $10,000 difference may not sound like much at first, but multiply it over 10 to 15 years and you're looking at hundreds of thousands of dollars. And boosting income isn't just about your paycheck. Ramit also encourages people to explore side hustles, projects or part-time work outside your main job. Thanks to the digital economy, an average American can start a YouTube channel, sell products on Etsy, or freelance on platforms like Upwork. These income streams might start small, but over time they can grow into something sustainable or even replace your full-time job. Ramit's point is clear. Instead of obsessing over tiny savings, focus on the big decisions that truly move the needle. Negotiating your salary, seeking growth opportunities, or building an additional income stream, that's the path to real wealth, not stressing over the cost of your morning coffee. Part 6. Defining your own rich life. Ramit Sethi ends I Will Teach You to Be Rich with an important idea. Wealth isn't just about having more money, it's about living a rich life defined on your own terms. And for Ramit, no two people will have the same rich life. For some, it might mean traveling the world without worrying about expenses. For others, it could be the freedom to treat their parents to dinner at a fancy restaurant, or simply working fewer hours so they can spend more time with family. He emphasizes that money is just a tool, not the goal itself. If you don't know what you truly want, you'll get stuck in an endless chase. A bigger house, a nicer car, more zeros in your bank account, yet never feel satisfied. But once you clearly define what your rich life looks like, every financial decision becomes sharper. You'll spend meaningfully on what you deeply value and confidently cut out the rest. For example, one American family might define their rich life as taking their kids to Disney World every year, creating memories that last forever. Another person might see their rich life as working remotely from a beach in Hawaii as long as they can comfortably support their lifestyle. There's no right or wrong answer, only the one that's right for you. And that's the biggest message of the book. True wealth isn't the number in your account. It's the ability to live the life you want with freedom, peace of mind, and happiness. If you found these lessons valuable, make sure to hit like and subscribe so you don't miss more of the best books on money and personal growth. Your path to a rich life can start today.